Good morning, dear participants, and welcome to EIOPA's Sustainable Finance Conference under the heading Time to Adapt. Today, we have a full program for you. We have 3 keynotes, 2 panels, an impulse speech, and 3 presentations lined up to inspire you. You will be able to ask questions via Slido using the hashtag EIOPA, and we will engage with you during the day with some polls. Before introducing Mrs. De la Torre, let me share a few thoughts behind today's conference. Adaptation is different from mitigation. We do not seem to be on a good path to limit the impacts of climate change to a degree which does not change our lives fundamentally. Climate change and the climate crisis is a humanitarian but also social crisis with disproportionate impacts on already vulnerable communities. And uncertainty creates challenges. We need to deal with complex scenarios in times when we crave stability, peace, and prosperity. Since 2018, EIOPA has been holding 5 roundtables on sustainable finance with an increasing number of participants. And through a number of initiatives, we've been able to build up the momentum for the insurance and pension sector, as well as the supervisory community, to take action. Today, we would like to tilt the discussion on the path to adaptation, because without adaptation and a change of mind, there's only so much we will be able to do in addressing sustainability risks. Our first keynote will be held by Mrs. De la Torre. Clara De la Torre is the Acting Director General of the European Commission's Directorate General, DG Climate Action, also known as DG Clima. Mrs. De la Torre, the floor is yours. Welcome to our conference.
Thank you very much, Mrs. Koormans, and good morning to all our participants. I'm really honored to be in this conference about adaptation, because we see the climate crisis developing, and it's becoming more and more urgent to all of us. And as you were saying, Mrs. Koormans, and the conference title says it is time to adapt. I would say it is high time to adapt, really, because let us look at what has been happening recently. Simply, the past summer has shown us that what's already happening with severe droughts, heat waves, floods that have affected much of Europe and much of the world, and has caused wildfires, has reduced hydropower capacity, has affected navigation, has destroyed infrastructure, has diminished crop yields, and, dare I say, most importantly, has taken lives away. So this has been really a catastrophic year in terms of climate impacts. So let us not forget that, as you were saying, mitigation and adaptation are different. So we have to address adaptation, and we have to continue working for mitigation, to continue in the path for not to go beyond 1.5 degrees. Because we see that already at 1.2 degrees, the effects are devastating. As I was saying, the climate impact, and as we all know, touches all countries and regions of the world. So there is urgency for action, because the more we postpone the action, the higher will be the losses and the damages that we are producing. And as you know very well, in COP27, which was held last month, as we all know, it was clear that we need to collectively strengthen arrangements for funding actions related to averting, minimizing, and addressing loss and damage, as current responses in terms of funding modalities are not really able to cover all needs and action. So we need to focus on solutions to increase finance flows and accessibility, and to close the gaps in the current global system. Both internally and externally, the European Union is committed to supporting countries and communities that are the most vulnerable, and not only on the climate change impacts, but also other factors as vulnerability to climate change, which is often interacting with other aspects. In the international scale, there are some very positive recent developments that we welcome. For instance, the so-called Global Shield Against Climate Risk, which is where important pledges have been done at COP, and we expect finance providers to further support and engage. COP27 will be mostly remembered for the establishment of new funding arrangements for assisting developing countries that are particularly vulnerable to the effects of climate change in response to loss and damage. And these new arrangements and the fund will build on the existing mosaic of institutions that currently provide assistance to developing countries and seek and this fund will have to fill the gaps of this mosaic. These new arrangements will help to better coordinate the initiatives of organizations, bodies, and national entities that currently provide support to developing countries. Moreover, the International Monetary Fund, the World Bank, and OECD have been asked to propose for the next spring meetings to find very practical range of solutions, such as new loans, capacity, and liquidity. And on top of these practical solutions that they are being asked to propose, the rules of our major international banks and development banks to mobilize exceptional public and private sector have to be modified. So their capacity to leverage both public and private finance has to be modified and made more agile and more fit for purpose. These arrangements, of course, as I was saying, agreed in COP, are focused on vulnerable developing countries for those that are most affected. But let us not forget that this does not only happen in the rest of the world, it's happening in Europe. We've seen that this year. And in Europe, every year, the extreme weather events produces damages of billions of euros. And so we need solutions for managing and transferring climate-related risks, both in the private and in the public sector. We need to invest more in adaptation. We know it's the only way to make our society and our economy more resilient. And the more we delay, let me insist on that, the more costly it will be in human lives and in economic terms. As you know, last year in 2021, in February, I think, the European Commission presented its adaptation strategy, which has a number of actions, but it has one which is particularly relevant for today's discussion, which is closing the so-called protection gap, which means closing the share of non-insured economic losses caused by climate-related disaster. And this gap has been widening over the past years and is now estimated at around 70%. To put it in concrete terms, almost 3/4 of all damages caused by extreme weather events or other climate-related events are not insured. And this very often, these effects and these damages, which are not covered by any insurance, very often go into the most vulnerable parts of our society and of our economy. So there is no doubt that we need to improve the insurance penetration with better products for climate-related risks that will be provided to clients for a fair price. And we have in the European Commission, so we are very aware of this protection gap, and we have launched very recently what we call the Climate Resilience Dialogue. So we have convened a group of representatives of a wide range of stakeholders interested precisely in reducing this climate protection gap. And there we have representatives from insurers, reinsurers, public authorities, regions, property owners, and corporate sector. And because we want to have really a well-balanced representation of all those that have a say for one reason or another in closing this protection gap. And we find this is a unique opportunity to get an understanding of the positions of the other stakeholders and to look together at solutions and to develop also to take commitments on what to do. So the main objective of the dialogue is to identify key points for advancing the contributions of insurance to building resilience, from actions to increase climate risk insurance penetration to incentivizing and investing in good adaptation solutions. So we have to do both things. We have to invest in solutions that address climate change, that address the effects of climate change, and we have also to increase our insurance coverage. And therefore, as you can see and as you know, insurance can play a pivotal role in building climate resilient communities. The more resilience, the less losses and damages. Let us not forget also, because we have to have products, but we have also to have demand side of insurance. And we think that public authorities need to analyze the cost of their self-insured assets or infrastructure. And private companies or individuals must be able to compare the cost of an insurance and the cost of covering the damage themselves. As we know, different regions, different parts of Europe, different parts of the world are affected in different ways by these extreme events. And in the context of this dialogue I was referring to, we are bringing in the community of practice that we are building under the mission on Horizon Europe, our research and innovation program. We are building there a community of regions that are committed to adaptation. So we are making sure that this community of practice of regions that are committed to go to a path of resilience in the coming years are part of this dialogue, because there are solutions that can be tested and deployed in this community of practice. So and we know that solutions are complex. Solutions cannot be the same for all regions, and this dialogue is very rich from both the supply and the demand side. So I would like to finish to thank EIOPA wholeheartedly for the participation in the dialogue and their support for the work of precisely reducing this climate protection gap. We highly appreciate your contribution and your participation in these moments of where we have to address the reality and to show the commitments of all the parties, because we need to work together to adapt now. A little bit later will be already too late. Thank you very much.
Thank you very much, Mrs. de la Torre, for this opening speech, and indeed also to the audience. Mrs. Hilkema will be speaking after Mrs. de la Torre, so thank you very much also for your flexibility. Now, I see already if we have the chance for one question, Mrs. de la Torre, after your speech, because it's good to have you on board. You've mentioned indeed the climate resilience dialogue, and EIOPA is very happy to be part of the dialogue, as you have mentioned a lot of insurance activities can contribute to adaptation. Now, if you think of the dialogue, what would you consider as your most desired outcome of this climate dialogue? Because it combines a lot of stakeholders, but towards adaptation, what would be the most desired outcome of this dialogue? Thank you.
The dialogue is I would say a mechanism or initiative to launch a whole panacea of actions. So we like both to develop the supply side, so that there are products that are being developed for the very purpose of closing this insurance gap. And also, one thing we want to have with this dialogue is collect good practices, because there is an insurance gap, but there are fortunately, some good examples of how this protection gap can be closed. So to animate, let us say, to animate both those that can provide insurance, those that have to take the insurance, to meet each other, understand each other. You have the insurance companies have a lot of data. Some of them are of course commercially sensible, and we're not talking about those. But there are a number of data that can be used for reinforcing the risk management. So on the one hand, make supply and demand join, and on the other hand, already disseminates the good examples and the good practices that are happening. Let us not forget one thing: is that if I am a private actor, I am not insured, I will have to pay, if I can, from my pocket, the damages. And if I cannot, very often is the public sector that has to cover them. So this has the insurance gap has an important fiscal dimension, because it's the public resources that will have to pay for them. Of course, the public will have to cover also the risk of their own risk, the public risk. So it's very important that we bring those that offer the coverage with those that have the risk, that meet together, and we close this gap as much as possible. And this will not be a one-off thing. This is launching a whole process, a changing sort of state of mind after this dialogue.
Thank you very much, and I'm sure we will be able together to communicate on the deliverables in our next conference. Mrs. De La Torre, thank you very much for your participation.
Thanks to you. Thank you.
Thank you. Then, heading over to our next keynote speech, with little need for introduction, we have Petra Hilkema, who is the chairperson of EIOPA. Petra, the floor is yours. Thank you very much.
Thank you, Pamela, and also thank you, Clara, for an excellent start of the day, and thank you for being with us. Thanks, everyone, for being with us. This is an important day for us. We really work towards this conference. It's one of our priorities. It's one of our key topics, and it is my pleasure to all welcome you today, and thank you for choosing to tune in with us and to deliver this keynote. Today, I will briefly introduce the main theme of the conference, adaptation, and I will outline some of the avenues to adjust to a changing climate, to a changing environmental, to a changing societal and digital landscape. We need to adjust, we need to adapt. That is the topic of today. I will also touch upon the role of supervisors in doing that, in going through that process. I will touch on the role of financial institutions, and also on the role that consumers can play in building the resilience necessary for adaptation. And finally, I will consider the power of technology in facilitating the transition to a more sustainable and inclusive economy. But let me start with the title of today's conference. Today we are confronted with major transformations which compel us to adapt. Climate change is a reality that affects the financial sector, economy, society at large, and we know that fighting against it requires a reduction in greenhouse gas emissions. However, climate change mitigation alone is not enough. So what I'm saying is just mitigate the risk, get an insurance, and continue as we were is not an option. To address climate change, financial institutions, companies, and citizens need to adjust, and they need to do it now in order to minimize future impact. We should not forget that the Paris Agreement includes a global goal on adaptation, and it aims to support the agreement's temperature reduction goal, and the recent discussions at COP27 showed the importance of increasing adaptive capacity and improve resilience to reach that goal. Repairing damages caused by climate-related physical risk is very important, particularly for vulnerable countries, for underserved consumers. But it will not make them more resilient to future climate hazards. It will happen again, it will happen more. It happen more intense. And these, a consequence of climate change, will affect all countries around the globe. Now, adaptation does go beyond climate. The environment and nature are also changing, largely as a consequence of climate change, which affects then weather patterns, water availability and biodiversity. More general, this has a wider societal impact. Throughout the transition to a more climate-friendly and sustainable economy, we will have winners and we will have losers. And it is therefore key that we also look for inclusion. And for this to happen, we need to adopt a different mindset. And that's why the title of today is Time to Adapt. But what exactly is required to strengthen adaptation efforts? Now, in my remarks, I'll focus, of course, on the financial sector and refer in particular to EIOPA's remit, insurers, and pension funds. Adaptation is about managing climate and environmental risks by adjusting economic agents' behavior to minimize climate-induced damages and to improve resilience. But it is also about addressing consumer detriment and ensuring inclusion. We do not want to leave anyone behind. Now, I will argue that supervisors have a clear role to play. And now you may wonder, why should supervisors look at adaptation? Well, climate change and environmental damage have a macroeconomic implication. They affect key economic variables, including income, savings, investment, and impact on companies and household finances. And all this is relevant for the financial sector, both being a service provider as well as an investor. For example, when insurers offer policies to consumers, they also they have an impact, but also they invest, and insurers have a role on both sides of their balance sheets. Supervisors' fundamental role is to identify, assess, and ensure the management of risk to financial sector, companies, and consumers. Now, take the example of natural catastrophe. Natural catastrophes are increasing in frequency and intensity, and risk coverage in Europe at the same time is low and patchy. And when I say natural catastrophe, naturally, we often think about the events that make the news, the really bad ones, huge flooding, major droughts. But what we also see is that just storms happen more frequently, and when they happen, they cause more damages. So it is in all scales of natural catastrophes that we see frequency and intensity and therefore damages going up. Now, supervisors can help with collecting and analyzing data to reduce blind spots. Where are these risks? What is happening? What could be the damages? And to also improve the risk awareness by supervised entities, businesses, and consumers. So if you know the blind spots and you realize you're not insured, you need to start thinking, what are you going to do? Are you going to adapt, adjust, mitigate, insure? EIOPA has further developed its dashboard on insurance protection gaps for natural catastrophe. And I'm very proud of my team. They've been really busy on building this, and I think they did an excellent job. And yesterday we published it, and we published it open source for all to use. And later today we will also present the dashboard and explain you how it works. But I think it is an excellent tool that people can go to and just see where are the climate related, particularly physical risks that we are currently encountering in Europe. Supervisors also set expectation on fair treatment of consumers through product oversight and governance. And also this is key, the fair treatment of consumers. And EIOPA has been working on identifying the drivers of protection gaps and the contribution to solutions. Now, and here I would really very much like to mention the Climate Resilience Dialogue that is organized by the European Commission, DG FISMA and DG Climate jointly. I think that's also very nice that they do this jointly. And it was opened last week, and I was very happy to join that opening. And Mrs. De La Torre is here today, and it just shows that with DG Climate and the financial industry together, we need to tackle some major issues, but we are working together, and I'm very happy she joined. Now, a quick reminder on the importance that I also want to give is on the importance on stress testing. So, of course, it's difficult to know what is coming, but a way to at least assess what might be coming and if we are capable to deal with it is stress testing. It provides insights into the effect of climate risk on the financial sector going forward. And so I also suggest you stay tuned today for with EIOPA and our website, because we will publish the results of our first climate stress test in the next weeks, but we will also discuss how we look at scenarios during the day. Now, Having said that, besides clear knowledge of what are the risks, what are the gaps, adaptation requires the actual management of these risks via risk-based solutions and an appropriate regulatory framework. The ability to identify and price climate-related risk is essential for the financial sector to develop, to offer and invest products that contribute to fighting against climate change and the damages that are caused by it. But do sustainable features in a certain product make the investment less risky? And is the past a good indicator, or is it ignoring transition risk going forward, hence not factoring in adaptation? These are key questions to determine whether the regulatory framework should be adjusted to include sustainability risk and factors. And it is a topic we have been exploring. EIOPA has conducted a preliminary analysis, and it will be subject to discussion of today's conference. Now, from a risk-based perspective, EIOPA has been working to detect common risk drivers and identify possible solutions to address protection gaps along 3 dimensions. And I'll mention them all 3. The first one is the supply side, and we did that with a focus on pricing and product design. How can we reduce losses through preventive measures, and which are reflected then in the pricing? And we call that impact underwriting. In other words, if you are insuring, you're also telling those you insure that they need to change something, or at least make sure they do something in order to adapt and mitigate the risk. So it's not just providing the risk for the damages, but it's also incentivizing other behavior to reduce the damages. And that we call impact underwriting. A second, what we looked at, is the demand side. We have been conducting behavioral analysis of consumers' preferences to understand why it is that consumers do not purchase insurance for damages that is actually available. And we will say more about this during the conference today. But what you've seen also during the flooding last year is that there was cover available, but many of the consumers did not take that cover. Now, why was that? Because if we understand the why, we can also think about the how to have more insurance penetration and have more insurance available to deal with damages when they happen. And the final route we're looking at is the macroeconomic aspects. We have been studying the macroeconomic implications of protection gaps and underlined the important role of insurers to strengthen societal resilience. And this we do together with the ECB. Now, in some cases, risk-based solutions, even when they are supported by an appropriate regulatory framework, might not be sufficient to cover systemic climate-related risk. Shared resilience solution must then be established to improve societal resilience. Going back to the example of natural catastrophe, their increasing frequency and intensity. It is raising questions about affordability, about availability, and in a nutshell, insurance are either offering very expensive insurance policies that can no longer be afforded by companies or people, or they stop providing the coverage for a certain type of risk. Think about pandemic. Think about other systemic risks. Now, this runs counter to our objective, of course, to improve climate resilience, to do impact underwriting, and to limit protection gaps. And that is why public-private cooperation could support in those specific instances insurability, thereby contributing to adaptation. But let me stress that public intervention is really the last step because it involves public money and it involves the public solving problems in a market. And I think we need to be minimizing that. But at the same time, I also say that while everyone should have a skin in the game, in this particular risk, there will be instances where we do need to discuss the need to have a public-private partnership to deal with the tail events that are out there and I would say will happen, unfortunately, but are likely to happen. Let's say it like that. Finally, a word on the reporting, sustainability reporting. A lot has been said about that. It involves a lot of work for supervisors, for industry. It is very important. Reporting of sustainability information by companies is essential to ensure transparency to investors, including transparency by insurers to the market. Only by knowing which companies are acting in a sustainable manner, insurance can make informed decisions about the placement of their assets and thereby contributing to adaptation. In the EU, European sustainability reporting standards are being prepared to this end. And with the SFDR coming into being, but more importantly, the CSDR coming into being as well, I think we are making good steps to increase that transparency. Now, finally, I promised at the end I would also say, at the start, I would also say something about technology at the end. So let me turn to the role of technology in helping supervisors, financial institutions, and consumers in the effort to adapt to environmental, climate, and other societal changes. Adaptation is a broader societal issue which requires long-term vision and an open mind to draw on digital innovation. To be able to factor in transition risk and to relate social impact that are linked to adaptation, supervisors need to follow a forward-looking approach in risk assessment. This is where technology is essential. Supervisors can become more efficient using artificial intelligence and machine learning. They can do so by drawing on the amount of data technology makes available, including in relation to sustainability. Supervisors can use AI to analyze and train IT systems to learn from such data and to feed the results in their analysis of climate risk. In this respect, it is essential to find solutions to share risk assessment and data in an open source environment. Supervisors can also use technology to improve macroeconomic modeling of social economic impact of climate change and natural catastrophes, or other systemic risks, to be frank, including pandemic, maybe cyber. Finally, supervisors can support the industry to mitigate the risk and seize the opportunities of digital transformation and promote a data-driven culture. Technological innovation, together with sustainability, are key objectives of our strategy that we've recently published, and it sets out our priorities for the years to come, 2023-2026. Now, AI and possibly also open insurance applications could help, and I look forward to hearing more on ideas and tools to adapt using technology in the Impulse talk this afternoon. Financial institutions can also benefit greatly from and contribute to development of digital technology, including through open data. For example, digital applications to predict climate hazards and weather events based on big data analytics can provide useful information to insurers and their customers. At the same time, technology can help insurers incentivize and preventative behavior. As an example, insurers could offer reduced premium to those consumers adjusting the structure of the building to improve resilience or considering climate patterns when seeding crops. Obviously, this helps appropriate privacy. This needs appropriate privacy and cybersecurity safeguards. That is always a requirement when we are talking about new technology. But if we do that properly, technology can help SMEs, for instance, to reach consumers via online services, thereby also saving transportation costs. So there's a lot of opportunity in there also to deal with the risk to develop a business as long as privacy and cybersecurity is safeguarded. Consumers, too, finally, have a very important role to play in adapting to a changing reality of climate, including by harvesting the benefits of digital innovation. Consumers can purchase insurance against major climate-related risks, such as weather disasters. They can also take a closer look at where they build their house, and thereby avoid disaster-prone areas and hopefully a lot of damages. Now, thanks to technology, consumers should be able to compare offers more easily and switch providers who offer better coverage. In line with incentives, hopefully offered by insurers, policyholders can also adjust their behavior to prevent risks from materializing. Behavioral data would feed into industry and into supervisors' assessment, creating a positive circle in a data-driven economy. So it really starts from data, from good models, from understanding what we're looking at, and then adjusting in order to reduce risk. Now, I do need to say a word of caution here that is always needed when we talk about digitalization, and that is the risk for vulnerable groups, or in other words, those who are underserved. And they will be also possibly subject to detrimental practices, or they could be excluded. Now, therefore, whether we do it digital or we do it not digital, we should avoid exclusion, and we should always strive for financial inclusion. And in order to do that, we need to be conscious of how we build the tools that we are building through innovation. Let me mention at this point that consumers are also vulnerable to being sold products that are marketed as green while they are not. So then they're included, they have the products, they think they are acting in a green way by buying those products, but it turns out it's not green. This is what we call greenwashing, and supervisors are looking into ways to minimize that risk, as do insurers, to be frank. In this respect, also improving financial literacy will help financial inclusion, helping consumers understand what they look at, understand the information they are receiving. EIOPA is also working on greenwashing, and we are going to respond to a call for advice on the commission from the Commission on this, and I'm sure that the panel on this topic will discuss it in more depth. Now, before concluding, I would like to reflect on one more point, and that is the role that consumers can play actively in adaptation. As savers, consumers can decide to place their money in climate, environmental, and socially conscious products. However, as pension fund beneficiaries, they tend to rely on financial institutions who invest for them. Now, this is why the role of EIOPA in considering sustainability and possibly in membership preferences for sustainable investment also deserves our attention. And you will be hearing more about that again in a session this afternoon. Now I will conclude, and let me conclude with the key message that I started also with when I opened my keynote. Climate change mitigation is important, and it might have got us where we are today, but it is no longer enough. It is time to adapt to a changing climate, to a changing environment, and to a changing society. Efforts to adapt, build societal resilience, and ensure inclusion going forward. To do so, supervisors need to be having a clear view of risks and of gaps. We should also reflect on whether the regulatory framework remains appropriate or could be adjusted to facilitate the transition to a more sustainable and inclusive economy. Risk-based solutions will help, but we should consider shared resilience solutions for systemic risk as well. While supervisors, the industry and consumers can play a role in adaptation, technology will be crucial to support that effort. More importantly, a change of mindset is required. Indeed, with the right mindset, I truly believe we can all benefit from technology, from our efforts, and contribute to adaptation, ensuring value for money, and ultimately benefiting society. Now, with that, I know I set the bar high, but I think looking at the program, looking at the work that is being done by EIOPA, by our colleagues in the national supervisory authorities, but also by industry and by many, many others, I think we are up for this task. If we work together, if we discuss this together, and that is what we will do today. I thank you very much for being here. I hope you actively contribute, and I moreover hope that you will very much enjoy EIOPA Sustainable Finance Conference. Thank you, and back to you, Pamela.
Thank you very much, Petra. And thank you very much indeed. You said you're setting the bar quite high. And you've raised a lot of questions. Also, I see in the chat, people are questioning the role of governments, but also, generally speaking, always questioning the role of the insurance industry, the perception or the reputation of the insurance industry in taking really honest products to adapt actually to climate change, to the market. Now, there's one question, if I may. Of all these projects, I mean, we have a quite ambitious strategy in EIOPA on sustainable finance. And if you were asked to identify one where you think if we could, and if it would make really the biggest impact on adaptation, what would be one of these areas where you think there is a high potential of really changing people's mindset, as you mentioned?
Thank you, Pamela. Good question. And I must say I like many of the projects we have, so it feels a bit like choosing between my kids who's the favorite child, and I don't have a favorite. But let me take this question from a different angle. So where do I feel in a field where many are very active to make this happen? I do see a lot of really honest activity to go through this transition. But where can we really add the value? And I would say it is in the data collection. We have, I think we have a position where we can get a lot of data, and we have a high standard for the quality of that data. I think that's one. And then with that data, model risk, model it, and share that open source to the extent that we possibly can. And like with our NetCat dashboard now. Hoping that that will not just feed into discussion so people can base the discussion on evidence, but it will also raise awareness. So those who are not yet convinced or aware, they actually see that it is there, how it is there, what could happen going forward, and therefore hopefully also start to act. But I think also to ensure that when we discuss the problems, as supervisors, we can say, yes, this really is the number that we need to discuss. This is really the risk that is out there, and it's not a commercial interest or someone who is exaggerating. This is what we really need to talk about. And I think from that position, which is a non-commercial, I think a position of an expert when it comes to data collection and modeling, I really hope we can support the discussions that we need to have going forward in a group of many actors that hopefully jointly will bring this transition not just forward, but also up to a speed that we need.
Yes, indeed, a real breakthrough is what we're trying to achieve, and we have some academic participants also lined up in the conference to actually address all these open source applications, or really the use of supervisory and regulatory technical applications, indeed also to improve the sharing or the analysis of all this information. So Petra, with this, thank you very much for having taken this keynote speech to us, and we will definitely use much of your speech also to reflect on during the day. Thank you very much. Then going to our next topic, we have a little adaptation to our program, and I think Nomen is omen. Time to adapt. Unfortunately, Mrs. Valeur has not been able on short notice to join us. We're very sorry, and we hope all the best. But what leaves me then to maybe introduce to you a small poll we were planning to ask you. After you've heard these insightful key speeches, there's one question to the audience, and you can share your thoughts. The question to you is, if we want the financial sector to adapt to sustainability risks, what do we need? And while you're thinking of that, I will just go through the agenda, and hopefully it will not suffer more adaptation, although we're completely in the mood for adaptation. So please submit via slido.com #EIOPA. Submit your thoughts on what we need for the financial sector to actually adapt to climate change, but also to social risks, because we speak of sustainability and also the implications of climate change on social resilience. So in the meanwhile, I'll briefly, I think we have launched the poll by now. And for the rest of the day, after our coffee break, which will start in 5 minutes, we will invite our colleague Dimitris Safaris to start the first panel on climate change and financial stability. That will be at 10:10. We will call the participants on stage. And before lunch, we will still have 2 presentations on regulatory initiatives, because as a supervisor, as a regulator, of course, we always discuss regulatory challenges and opportunities, not only for insurance companies, but also for pension funds. And we will have those on board during the day. Now, I have the very, very great pleasure of informing you that Mrs. Valeur is being able to join. And that is a great news, because that will actually add to our program, not only to look at climate change risks, but also the corporate responsibility of corporate governance in actually making the change and changing the mindset. So while Mrs. Valeur is joining, and we will make sure that all goes smoothly, I will look at the poll, whether the poll has given us some inspiration for the day. So please bear with me. If you all agree, then we will have Mrs. Valeur's keynote speech, eating into your lunch break. So I would suggest, if you would like to catch a coffee, you can do that now, but come back in a minute while we show the poll on the screen. I'm looking at my colleagues. Yes, there it is. What do we need to make the financial sector adapt to sustainability risks? And I see, yes, initiatives from public and private actors, data, carbon pricing, responsibility. And I think responsibility, Mrs. Valeur, is a very important maybe transition. Responsibility. And indeed, let's move on. Thank you very much for the poll. We'll keep this in mind. Mrs. Valeur, thank you very much for joining our conference today. We're very pleased to have your perspective on the sustainability discussion. And indeed, Mrs. Mrs. Valeur is the chair of the board of Blackstone Financing, but also, and maybe very relevantly also for this conference, the founder of the Global Governance Group and the Board Apprentice Group. And with this, Mrs. Valeur is making a major contribution in changing the mindset of corporate governance practitioners in actually addressing diversity and inclusion on the workplace, but also addressing sustainability going forward. Mrs. Valeur, the floor is yours. Welcome to the conference.
Thank you very much. Thank you very much for the introduction and for having me here today. And I apologize, I came in a bit late. I thought I was here on 9:40, but it's 9 o'clock here now. But I'm here, so that's good. Welcome, everybody. It's always nice to be part of these events where we can talk about things and share experiences in these areas that are so important. I'm a banker of background with 40 years of working in the financial sector. First as investment banker, then on various boards the last 15 years. And really the board experience that I have picked up over the years have showed me how we should have these discussions and who we should involve in having these discussions to ensure that the agenda moved forward. So when we talk about sustainable finance and sustainability generally, for me, the whole aspect of equality and equity and which voices you bring to the table is a very important aspect to ensure that actually we make the right decisions. And it's something that's very often forgotten if you want the S in ESG, the whole social impact. I think it's very, very hard to ensure that you look after everybody in a sustainable way if you don't have everybody at the table to make decisions that are concerning everybody in this way. For example, I feel that we should make a more stronger effort to bring the younger generations to the table to make decisions around sustainability, because it is in fact their future we're making decisions on. And we are not always in the right place to make it, the older generations, of which I put myself as part of, because we grew up in a different world. I'm born in the 60s, 70s, 80s, 90s. It was very different from this century. And I think that's something we sometimes forget, that we can use everything we know from then, but we just can't. We need a new thinking coming to the table. Effectively, the ones who created the problem are very unlikely to find a solution for it. So what do we do to broaden it out and to actually ensure that we get that diversity, those different voices to the table? And who are those different voices that we haven't got there currently? Most people will think, oh, well, that's a good old gender discussion. It's way beyond that. For me, when we talk about diversity, we need to have cognitive diversity. We need to have people that think differently. And to achieve that, because of the sort of cognitive level we all work at this stage, we are focusing on the visible differences that we can see, because that's the first marker we can help sort of move the dial on a bit. So women, ethnic minorities, but pushing away, for example, certain invisible disabilities, neurodiversity, younger people as well, for sure. It's just not that accepted to bring young people into decision-making processes at the highest levels, but we do need to do that. I mean, basically, for me, the way the world is going, and certainly discussions we have in boardrooms, is that if there's no ESG, there's no finance to be had as a business. And I think that's something to very much keep in mind. But we can't get the ESG right if we don't have the right people around the table. So to be able to create this a coherent sort of sustainability strategy that includes everything and everybody, we need to bring in everything and everybody to that table, which is quite logical, really, to me at least, but it seems to many people to be quite okay to discuss these kind of issues with a very homogeneous group of people around the table that unavoidably will find it easier to make decisions. But that's not what we're there for. We're there to turn all the stones and bring everything into play. You are not able to do that if you're a very homogeneous group of people. So for me, what I'm seeing is that the demands, like in terms of where are we actually going, the demands for equity. So there's a difference where people talk about equality versus equity. So equality is that there is a fence that it's the same height. But if we're different heights, we can't all look over the fence. If we want equity, some of us might need a box to stand on to be able to look over the fence, which is a good description of the difference between equality and equity. People will say, well, the fence is this height for everybody, so that's equality. Well, it isn't, if because we are different heights. So I think we need to very, very much, as part of the whole sustainability agenda, incorporate the different people around the table. And I can see that people are finding that difficult. In the different boards I'm serving on, and also various committees, only a very small number of people actively bring to the table whether we have ensured to have all the voices ready. Even within the charity world, when we have panels and everything else, if you only hear from one kind of people, you're just not covering all aspects. It's not possible. It's not physically possible to cover all aspects with a very small number of similar kind of people. And even when we started bringing women to the table more, this is an area I've worked in most of my life, and I now advise companies on how to try to get it right. But even when we do bring some of the visible disability, it's not disability, diversity, it does seem to be the same kind, but with different gender or different ethnicity, but from the same backgrounds, from the same kind of education, from the same layer in society. And that's really not going to help us, because cognitively they will be very similar in how they think. And that's why we need to look a bit closer at that. To actually move that on within the executive teams, we do need to look at measurements and KPIs. What gets measured gets done. Before we start having these other very important climate change discussions, for example, as we've seen in all the COPs, we are having a significant amount of men and a very small amount of women, and an even smaller amount of ethnically diverse people discussing what we should all do for all of us. And it just seems extraordinary that in 2022, we are still struggling, even in the gender area, in the Western world, that we haven't managed to get to a place where it's very natural that we are 50-50, and it's very unnatural to be anywhere where we are 100% either gender. I think that's just something that just needs to be moved on. We need to lead by example. We need to move that agenda on. I think some of the barriers to do that is actually looking at ourselves as well and our own cognitive development. I would say that teams, groups like boards or executive teams that are not diverse are not necessarily cognitively developed to understand why it's so important, and why having different voices to the table is very important to get sustainability moving forward in the right way. There's something called spiral dynamics, which looks very much at the different cognitive levels people operate at. And I think that's very much playing in here. So we have the first 3 levels, about 80% of the world population are operating at those levels. And those are levels where diversity is not fully understood. Intelligently or intellectually, we can understand the principles of it, but there's always a reason why we are not quite making it happen. Because the full understanding of what it means to have a diverse group around the table, where you really feel that it's urgent over and above starting the discussions, is just not there clearly, because we're seeing it very clearly in front of us. Unfortunately, with operating at level 1, 2, 3, a lot of it focuses around the ego, if you want, but a lot of the younger people naturally come in at level 4, 5, 6, where it's more about the whole of the world, the whole of the country, the whole of the company. It's a different way of thinking. It's not about you anymore. It's about the whole, with you as part of the whole. And again, that kind of thinking is not very well understood. People tend to stop at the first, 3 levels and not push themselves to go further in their leadership and further in how they look at the world and how they look to make decisions. So this is very much about how do we make decisions in the decision-making groups that are all over the place. And I think we shouldn't make decisions without having ensured that we have different aspects and different kinds of people onto the table. So with the spiral dynamics, for example, we have someone like Nelson Mandela is said to be, for example, operating at level 7, which they call the teal level. This is something that's been researched and worked on for 75 years. So coming out with thinking, being at the teal level, which is they have colors and levels, but within a country where the levels the country operates at is 1, 2, 3, it's very difficult to implement a higher level than where people actually are. And that's the same in boardrooms and in leadership teams. When people actually are at level 1, 2, 3, and you want to implement at level 4, 5, 6, the resistance to that is going to be so big, and it's going to be in all kinds of different ways: passive aggressive, willful, blindness, or simply finding excuses for why it's not possible to bring all of us to the table so that we can get the variation of input from everyone. And it's quite sad to see that we in this century, with such urgent problems, sustainability problems, with the climate change especially pushing forward, but also with a rising level of social unrest in many places, it's very sad to see that the group of leaders are not able to operate at the level that is necessary right now to operate at, to understand that the world is one cell. It's one group that we're all part of. Nobody is an island. Nobody can exclude themselves from the planet. We are here, all of us together. And when you harm part of the planet, you harm part of yourself. I think people don't see it that way. They're like, well, if I do this, I get lots of money, I'll be rich and happy, and I don't need to care. Well, actually, if society breaks down, then suddenly you will find that you will need to care, because what you thought you had, you might not have anymore. And it's completely out of your control. So that's the ultimate risk, of course, and hopefully it won't happen very soon, but it will happen at some stage if we don't change the course of what we're doing now, if we don't include everyone to be part of making the decisions. So how do we do that? Obviously, governmentally, everybody has a voice, everybody has a vote, and can vote to ensure that we get those different kind of people to help steering our various governments in different countries. At a business level, we should have very clear KPIs that are publicly announced, that shows that the leadership team will have diversity KPIs that will directly affect their financial return, so to speak, their income, if not fulfilled. Unfortunately, it seems that this is the only way we can really move the dial, or have laws in different areas, which I've always said should not be necessary. But actually, what we have ended up with now in a situation where the sense of urgency is increasing by the week. And that's why we have the social unrest. If we want to stop that, maybe we need to implement some laws to stop the passive aggression, the willful blindness, the not wanting to change anything, and to force through some changes that are very, very needed to make sure we can push society forward in the right direction. I personally feel that the lack of diversity in many places is to blame for the lack of progress. It simply isn't good enough to sit and talk about what should we be doing within a small homogeneous group. You will never get to the right place in that way. It might not be pleasant to hear people that has different ideas to yourself, but it's very necessary. The only way you grow, any one of us, the only way we grow really is when people disagree with us. When we all agree together, there is no space for growth. We haven't moved, we haven't changed, we haven't, impacted each other with different ideas and different ways of thinking. And that's also why it's so sad that we can't move this need for diversity on faster than we are, because we shouldn't even be having the discussions on sustainability that we have today if we don't ensure that we have those diverse voices at the table. So the KPIs are definitely one, but even that is a place where boards are not super willing to put them in place. They kind of seem to think it's unfair, and we hear the good old, oh, but we can't find these people and we can't find those people, and they're not available. Trust me, the talent is there in all of the diversity areas for that very small number of leadership positions that are available for various people. It's just that the current groups in those positions are not willing to share the privilege that they have of having reached that point. And we get that that's a hard slog. I mean, I have worked intensively for 40 years to be where I am. But if there's someone that I can bring to the table that has different ideas to me, that has different ways of looking at things, I would welcome that anytime. And step aside when realizing that maybe my ideas are now outdated. And then it's time to step aside. If we stop growing and learning, that they will become outdated. And a number of today's leaders would have stopped growing at the end of the last century and holding on desperately to what things used to be as opposed to what things should be. And I think we all have a responsibility to look very closely at ourselves on what are we doing every day to bring diverse talent to the table? What are we doing every day to make sure the pipeline is being built, to make sure that we're developing different kind of people throughout the organizations that we're leaders of and that we are serving? And ultimately, we are, of course, serving the planet, because nobody can make money without everybody here. So ultimate stakeholders will always be everybody. And we are accountable to everybody, in my view, as leaders, for ensuring that when we make decisions that moves all of us forward in the right way. I feel that when we don't do that, we should feel shameful. Unfortunately, it doesn't seem to be the case, but I would recommend trying to, for leaders to be more humble in this aspect and feel shameful when we hold on to something that should be passed over to different kind of people. I know this sounds a bit harsh to say possibly, but for me, we will not change anything if we don't change the people around the decision-making table. And that comes and starts by looking at ourselves, at welcoming differences, at hiring someone who doesn't fit in. We are so obsessed with people having to fit in to teams, to the culture. Well, what are you getting when you find someone who fits in? Are you getting diversity? Or are you just getting someone who has the same opinions as you? Because that's comfortable and makes it easier to make decisions, but it also makes it easier to make mistakes. And it also increases your risk of overlooking various opportunities that simply you haven't got the eyes to see, and also missing risks that you don't have the eyes to see. So in the diverse teams I work with, in the boards where we have that diversity, we have longer discussions, we have richer and deeper discussions on every subject that we have, and that makes us come out with better solutions, in my opinion. It takes longer and it can be hard work when many people disagree on things, but it's very necessary. It's through disagreements we grow. It's through disagreement we find solutions that are better for all of us. Thank you.
Thank you, Mrs. Valeur. Me and my colleagues have been taking notes. It was such an inspiring speech, and I'm very pleased also to hear. Actually, I was looking for a KPI for cognitive diversity and actually the success of bringing diverse, and it's the level of disagreement, if if I may say it.
That's a good KPI, yes.
That's a good KPI. So I think that's something we can work on. But and indeed, how do we achieve the dynamic to take we decisions rather than I decisions?
That's right.
And that's the path we should go on, especially if we want to adapt to sustainability risks. So thank you very much, Mrs. Valeur. One small question for you, and we need to be a little brief, but I hope all the audience, they are aware that also your contribution will be available on YouTube, so we can put it on our speed dial. But actually, what is then the best way? How do you think you can really break the pattern and get young voices into a corporate board? Because young voices think they can't, they don't know where, they are dismissed as too young and unripe. So what is your most successful tool? Thank you.
So I started serving on boards at 42 and I was told I was too young. By then I had already worked over 25 years. So I'm thinking, well, I'm here, so it's off, right? Excuse me my language, but you know what I mean? It's for me, what we can all go away and do today is find a young person that we take on as a reverse mentor. I've had reverse mentors for 12 years. I've had 14 different young people under 30 mentoring me for a year. I have one meeting a month for 1 hour for 12 months. Through that, they talk to me about how they live, what they, how they are looking for jobs, what they're expecting of a workplace, what they want the world to go towards. The insight these young people have is significant, and it's beyond the insight that we have. And again, we have to be humble and allow young people to teach us. And what better way to do it on a one-to-one? They're becoming more than 50% of the population rapidly around the world. It's not like we can't find a young person to talk to once a month for 12 months. That young person will be able to put on their CV that they have mentored each one of us and use that. It's a leadership education for them because they are holding a relationship with a senior executive or a board member or a minister. And through that, they learn to do that and they learn to be in that collaboration with an older person. So every one of you, if you do one thing, go out and take a young person as your mentor, teaching you how the young people work and what they have to bring to the table.
Thank you very much, Ms. Valeur. Reverse mentoring, we keep it in mind and we hope to get some people interested and motivated by that. Thank you so much, and it was lovely to have you here on our conference.
Thank you for having me.
Thank you. Bye. And without further break, I would like to invite our panel, our first panel of the day, on the stage. And just a brief introduction, we have Dimitris Zaferis as the panel moderator for today. And Dimitris Zaferis is the head of department of the Risks and Financial Stability Department at EIOPA, responsible for financial stability, crisis management, and studies and statistics. Dimitris, the floor is yours. Please go ahead. Thank you.
Thanks, Pamela. Thanks also for navigating us through through this conference so far. Climate change. Well, climate change and financial stability. This is what we're trying to discuss in this panel. Actually, I had in mind to talk for the next 1 hour about what we have been doing here in EIOPA on the topic, be it of sensitivity analysis of physical risk studies. Pamela told me that I'm not supposed to, I just need to moderate the panel, and that's what I will try to do. So when it comes to climate change, we heard bits and pieces on the topic from the keynote speakers. Climate change will have profound effects on the severity and frequency of NatCat events, so natural catastrophes, increasing the losses and the damages and widening the already substantial protection gap in Europe. The panel will discuss the impact of climate change on the industry and the economy overall, seek solutions perhaps for sharing the risk at the macro level. We will discuss how risk assessment tools like stress testing could help identify climate risks to which the financial sector is exposed, as well as in assessing the transition towards a more sustainable investment and underwriting environment. Now, for that, we have a panel with us. We have a diverse panel to the minimum when it comes to the background, where our panel members come from when it comes to expertise and experience. I will very briefly present our panel members to you. We have Renaud Guidet. I hope, Renaud, I'm pronouncing your name correctly. Renaud is a Chief Risk Officer in AXA since 2019. In addition to his role, he's serving as a chairman on the Net Zero Insurance Alliance. In his background, in his past, Renaud had his way through, obviously, the private sector, investment banking roles. But what I would like also to highlight is his commitment in his role when it comes to diversity and equal opportunities, translating into community involvement, and on that, in more tangible terms, he's a member of the board of Article 1 in Paris-based. It's a non-profit organization mentoring high-potential students from low-income suburbs. We also have with us Paul Hebel. Paul heads the Systemic Risk and Financial Institutions Division of the European Central Bank. In his role, he leads systemic risk analysis for the euro area, feeding into the ECB's financial stability review, as well as macroprudential policy for the largest euro area banks. Paul also acts as a co-chair of the SRB's analytical working group, as well as the Eurosystem's macroprudential analysis group. Now, in recent years, Paul has also been leading the climate-related initiatives and the SRB, as well as the Basel Committee on Banking Supervision, and I think useful input will come to our discussion from his role and engagement there. Our next panel member is Vicky Saporta. Vicky is the Executive Director for Prudential Policy at the Bank of England and the PRA, the Prudential Regulatory Authority in England. She has held a number of positions in prudential policy, financial stability, and monetary analysis in a career over 25 years at the Bank of England. Vicky was at the heart of the macroprudential and microprudential policy reforms undertaken by the Bank of England back at the financial crisis and leading prudential policy work since July 2016. Another interesting element on Vicky's engagement is her current role as chair of the executive committee at the IIS, the International Association of Insurance Supervisors, and she's also a member of the Basel Committee on Banking Supervision. Finally, Martin Spohl. Martin is the head of sustainable finance in the European Commission's Directorate General for Financial Services. Now, prior to his current role, he has also head of the Capital Market Unions Unit, the Economic Analysis Unit, Deputy Head of Banking Unit, and Assistant to the Director General, directly involved in developing key projects in the area of financial services since the banking crisis. So, quite a high-level panel with a lot of experience and a lot of input to bring to our discussion today. I would like to see if we can answer, let's say, 3 high-level questions. What is the impact of climate change on the financial stability of the insurance sector and the wider economy? How do we measure this impact? Are there risk assessment tools at hand? Is there a role for stress testing? And well, after we assess the risks, we quantify the risk, is there anything we can do about it? So what could be the potential policy actions to address these risks? So without any further delay, I will start our discussion by posing our first question to you, Vicky, because I would like to start, let's say, from the overall, from the big picture. Climate change is obviously not a European issue only. How do you assess the impact of climate change in the insurance sector? And what is the experience you can say that you can bring in this discussion from the IIS involvement? What are the different, let's say, risk assessments, and how they have been done at the global level, and what is the supervisory convergence at that point? And when we're talking about supervisory convergence, when it comes to analyzing risk, what could be and what is the role of the IIS?
Thanks very much, Dimitri, and thanks very much to EIOPA for having me on this panel, and good morning to everyone. So there's a lot. It's a very rich question. In terms of what are the broader financial stability and microprudential and supervisory risks from climate on the insurance sector, I think the channels are now well understood. They obviously impact the whole of the balance sheet of the insurers, both the liability side, with the potential for increased physical risks. The liability side also because of transition risks to the extent that insurers extend insurance to sectors that are not in line with transition plans. And on the asset side of insurers' balance sheet, particularly transition risks when assets are not in line with transition plans. In terms of, I mean, the ultimate consequences of these risks when they crystallize will impact on policyholder protection, and then they can impact on policyholder protection in a couple of ways. First of all, by impacting on the safety and soundness of insurers, or if insurers seek to protect themselves through increasing premia or excluding customers through an increase in protection gaps. And the potential of this increase in protection gaps creating broader public policy issues and financial stability concerns if, for example, there is underinsurance that could spill over to other parts of the financial sector. So in terms of how do we manage these risks and what we have been doing at the global level, there is the issue with climate, with actually managing climate risk, is that it operates in horizons that are unusual for risk management. And unusual actually for supervisory and regulatory horizons. So for instance, capital, as you know, usually has a 1-year horizon in terms of capital setting. Of course, reserving has longer horizons, but then again, it gets managed through the tools that I referred to. And stress testing and scenario testing also usually has kind of 5-year or medium-term horizons, and certainly not as long horizons as climate. So that's one challenge and one difference. The second one, which is very important, is that usually when we do regulation and supervision, we rely on historical data. And historical data is less relevant, and we don't have it because we haven't experienced severe climate risk phenomena in horizons in the past that we have data available. So that means that the risk management that we need to use needs to be forward-looking. And of course, risk managers and supervisors have other areas of responsibility where they need to be forward-looking and take into account risks which have not crystallized in the data. And one particular tool that is particularly useful is scenario analysis, which is different from stress testing. Because it does not, it basically sets out a number of potential paths that could take into account and asks the insurance sector and insurers how they would fare under them using the best analytical tools that they actually have. And this is the most evolved, the tool that is being used increasingly by others. The last challenge is that I talked a lot about the challenge of transition risk. Is basically we rely quite a lot on what governments are going to do in terms of setting out transition plans. So in their absence, there is a challenge in actually measuring risk. Again, forward-looking scenarios can overcome the challenge. In terms of IIS priorities, we're looking at data gaps. We have a big project on this, and we're trying to fill them in ourselves in a proportionate way in order to try to assess risk exposures in the best way that we can, recognizing that they're going to be subject to uncertainty. And secondly, we're doing a lot of work on scenarios, including workshops with the supervisory community. We had workshops involving 400 jurisdictions on trying to exchange best current practice on scenario analysis. Let me stop here. Thanks.
Thanks so much, Vicky. I see you have the same temptation as I do. We can keep on talking on the topic for hours. We do need to restrain ourselves. Going now to you, Renaud, from the point of view of the private industry, from the private sector, and a major global insurer. How do you assess climate change risks on the investment portfolio or on the underwriting strategies? And how do you see, and if you see, a convergence when it comes to the understanding and assessment of these risks in the different markets where you operate?
Sure. Well, thank you very much, Dimitris, for raising that question. Thank you for hosting me, and good morning to all of you. I hope you're doing well. Let me start with a report that was recently released by AXA, which is publicly available on our website, which is called the Future Risks Report. We publish it on a yearly basis after canvassing the viewpoint of experts worldwide and the broader society, to get the pulse of public opinion. And what is very telling is that in this year's edition, as you would expect, geopolitical risks featured prominently, but even above those, the concern about climate change was the most widespread. And for the first time ever, since we've been starting doing these reports 8 years ago, climate change is actually topping the charts across all constituencies and all geographies. So there is now a widespread recognition and awareness, but it's fair to say that we insurers haven't waited, for that awareness to spread in the general public opinion to actually be acutely working on that, because we insurers, both as investors and underwriters of risk, are at the forefront of climate change. We can experience firsthand the natural catastrophes, some of which are definitely driven by climate change. So we are uniquely positioned to understand the magnitude of the challenge and address it both in terms of climate change mitigation and climate change adaptation. And our approach is exactly the one you described, Dimitris, which is to be holistic, encompassing all the dimensions of our business: underwriting, so providing insurance coverage, investments, asset management, and also obviously our own operations. And to us, it's a key feature actually of managing our risks, not only due to the regulatory framework, and I think Vicky very relevantly alluded to the fact that many requirements only have a 1-year horizon. But when we design the strategy of our group, we plan for the next decades, not for the next 12 months. As you know, we are a diversified multi-liner, and just like when looking at life insurance policies, we have to think about the going concern and how we will be able to live up to the commitments we have made to policyholders in 20, 30, 40 years' time. The same goes for the P&C business, not only for reserving for long tail lines, as Vicky mentioned, but also because we want to make sure that actually we will have an addressable market, and so we need to take care of it and to address the challenges raised by climate change. So this is why at AXA we have invested a lot in in-house NatCat modeling to make sure that we can review the various impacts of climate change and take action. We definitely incorporate it in our day-to-day risk management, and it's our bread and butter, not because we are compelled to do it, but because we believe it's the right thing to do. And if you focus on value creation, if you focus on a successful strategy, if you focus on proper risk management, you have to focus on climate change. So it's part of what we do every day. And I think that we welcome the stress test which you mentioned, Dimitris, as a very useful tool, in a sort of a sparring partner mode, because as was mentioned, especially by Vicky, that topic is probably less mature than others. Science is very dynamic. Data gathering is evolving, and actually, I think we have now a good hindsight about natural catastrophes over the past decades and the acceleration of the pace of climate change and the magnitude of various perils, including secondary perils, which are taking an increasing importance and which may not be secondary anymore for some of these. But it's very important that we continue, that very active dialogue with supervisors, which I believe is helpful for all of us to better understand what it is about when it comes to climate change. And we go, beyond the 1 year time horizon or the 1 to 5 year. We actually can do projections on a much longer period. And to me, it's fundamental to the efforts of our industry to cope with climate change. The one thing I would wish for is to make sure that all of these stress tests can actually leverage our collective wisdom and be as coordinated as possible. And this is why I welcome the fact that this conference today is hosted by the EIOPA, because I think it's great that we can have as much convergence between supervisors as possible to avoid, duplicating or reinventing the wheel. Sometimes we feel that in various jurisdictions, similar questions have been addressed. So maybe what I would suggest is we can pool all of that, because ultimately climate change is a global phenomenon. It knows no boundaries. So it's very important that we can pool, all the data, all the expertise, all the resilience that we can build and that we can actually assess in the course of stress tests in a very coordinated fashion. I will pause here.
Renaud, perhaps a follow-up question before moving to the next panel member. And trying to leverage on your global experience, do you see any differences, the reverse of convergence when it comes to the understanding and assessment on the different countries where you operate? So when it comes to climate change, is there a convergence there, or do you see that there are different levels of understanding or catering for this type of risk?
Well, that's a great question, and thank you for bringing it up. I think that we've been converging. If I compare to 5 or 10 years ago, now there's a widespread recognition of the very existence of climate change and the magnitude of the challenges it raises. My fear is that there could be a divergence in the level of commitment and optimism and determination in the fight against climate change. And you could see some people saying, oh, yeah, it's a big challenge, but the cost of mitigation is too high. Let's just adapt. Let's rely on innovation, to save us at the 11th hour from a doomsday scenario. And I think it's very important that we keep in mind that we need to roll up our sleeves right now. We need to front load the effort, and there's no bypassing climate change. So my view is that awareness has grown. Convergence and the importance of mitigation still needs to be worked on.
Thanks a lot. Now, Paul, let's come to you. Also nice to see you in this context. So climate change is not solely an insurance issue, of course. What perspectives can you share as chair of the ESRB project group on climate change? And there, in particular, in your role within this context, bringing together, let's say, impacts and assessments from all sectors, banking, insurance, also the investment community. Do you consider climate change risk as a potential systemic risk for the financial stability overall?
Thanks, Dimitris, and great to be here with all of you on this panel. Actually, I might just pick up on the last point of Renaud. So this point that individual risk management, whereby you see firms saying often there's heterogeneous responses, and some of them say, yes, I'll wait to adapt. There's no rush. Climate's a long-dated issue anyway. Obviously, at the level of the system, you can imagine if there's a rush for the exit at the same time, this could create a calamity. And this is the nature of systemic risk. When individual risk management does not really add up to system-wide management. And I think in this respect, I think one of the things we've been finding as we go along is that climate seems to be often characterized, and perhaps sometimes by the work we do, in fact, with smooth scenarios as a problem of the future. But I think in reality, you have to think climate is not only in terms of veracity of natural disasters in the last years already growing, as it's in the baseline 1.2 degree warming, not even a risk at this stage, and it's only going to get arguably worse. But also there's uneven financial sector impacts. And where they pop up with the growing scrutiny of financial markets implies, as financial sort of salience grows of losses, either physical or transition risk, we can imagine that could create some expectation shocks. And markets are very much forward-looking, and that could really trickle through into the entire system. So insurers would be impacted, but I think what has to be taken into account with the systemic perspective is all of the interactions that might occur along the way, and make it just a more bumpy transition than we necessarily conventionally think about climate change. Now, in the system-wide context, I think I can maybe just say what we think, based on the work we've been doing so far, what we feel we're very confident, what we actually feel we've measured well and we know well. And I think it's really about where are the vulnerabilities in the system, i.e., in the level of physical risk, we see a lot about geographic vulnerabilities and where they're distributed. And I think more and more through interaction with natural scientists, through application of granular data sets, we know a lot more about the distribution of physical risks as such, where the hazards are most salient. And in fact, over the next 20 years, I think we can expect in some particular parts of Europe, at least where we're resident and focused, that maybe in the Mediterranean basin, you might see more heat stress, wildfires, water stress, in Central and Eastern Europe, more flooding, just to give you a bit of an example of the type of distribution of sort of vulnerabilities we see. And within that context, I think our big surprise is when we looked at this, around 30% of bank exposures, loan exposures, tend to be towards compound physical risks. So some combination of risks. So it's not a small number to be managed. And in the transition risk side, I think, there's this area that this Schumpeterian adjustment will be quite strong. We see, at least in 2021, our work showed only around 1% of investments in UCITS funds were actually aligned with the taxonomy, the green taxonomy of the EU. And if you look in more about the exposure types, you could say, well, around 1/3 of insurers, investment funds, or banks tend to be invested in high-emitting firms. So that needs to be managed. And bank loans is even worse, with around 2/3 of bank loans in Europe towards high-emitting firms, if you stratify firms in terms of their emissions. So clearly that these are all issues that need to be managed. I think we've managed to measure them quite well. Greenwashing is still an issue, of course, when it comes to, how shocks might materialize in informational shocks, in particular in the financial markets. And I think we're now investing much more heavily is not in where the vulnerabilities are, but how and when might risks materialize. And I think this is the current work we're really involved in. And there, I think more and more we're convinced with this idea of bumpy transitions, lots of trade-offs, and strong distributional impacts along that transition. And I think with this in mind, I just maybe round out my opening remarks to say, I think that the role of insurance is really key when it comes to undiversifiable or undiversified risks. We need to really tackle those particular elements. Because I think what we can say with systemic risk is certainly ex ante is sometimes hard to predict where and how it will actually emerge, but ex post, you know it when you see it. And I think when you see it means, I think there's the area of compound hazards which are going to occur along the way. So, floods tend to get more floods. Water stress, heat stress, wildfires tend to be also interacting quite a bit. You have elements of financial system linkages through counterparties, market risk, of course, through amplifications, cross-holdings of assets. With also in mind, I think the insurers, I'd say two things really come out and jump out at us in terms of their role in the financial system. One is insurers really tend to smooth losses. So if you have ex-ante insurance, what we've seen is that ex post after natural catastrophes, there's a lot less GDP loss. And all roads about systemic risk always lead you back to welfare losses, systemic risk about GDP losses. So here I think the smoothing of losses either through time or across counterparties is a key role for insurers to play in the system. And secondly is this idea that prevention is better than the cure. I think systemic risk along the path being bumpy, the more you can sort of rule out these sort of marked adaptation shocks where everyone moves at the same time and have more ex-ante adjustment, the better. And I think here, of course, insurance is a clear way to have more sort of ex-ante vision on where losses will materialize and who will absorb them. Back to you, Dimitris.
So much, Paul. I think we may say that this concludes the first round of thought, at least on this engagement today when it comes to the overall picture and to the overall assessment and let's say links between different types of risk when it comes to climate change. And then the next question would be, how do we assess them? What's the best way to deal with this type of risk when it comes to assessing the impact of climate change? I will turn again to you at the beginning of this question, Vicky. You are in a unique position there to assess the tools that supervisors and the industry are employing when it comes to the relationship between climate change and risks, both from the IIS, but also because from the IIS role, but also because at the Bank of England, you have had a quite leading role when it comes to stress testing or sensitivity analysis or scenario analysis of climate risks. So the question for you would be, what perspectives can you share with us when it comes to the tools that are being used and the results obtained so far? And again, bringing and both hats that you share sometimes, and the international one and the one that you have been, let's say, leveraging on from your national experience at the Bank of England.
Thanks, Dimitri. In terms of what supervisors globally have been doing, they, and helped by the international standard setters, and this is true not only for the insurance sector, but it's true for other sectors. So effectively, there have been issuing supervisory guidance. So they have not been incorporating climate risk within Pillar 1 regulatory frameworks, so the equivalent of the SCR in Solvency II, but they have been issuing supervisory expectations. And these are, the Bank of England, I think, issued the first such document back in 2019. These tend to focus on existing principles of regulation, such as good governance. So in the bank, for example, we're expecting that each company, not only insurers, but also banks, have a senior manager and a senior management regime, which includes individual accountability at the senior manager level, that is responsible for climate risk and reporting on climate risk to the board. Second, it's about risk management and the use of scenario analysis and stress testing. So that's very common as part of wider enterprise risk management. So, and expectations by supervisors that this will be integrated in the wider enterprise risk management, and within insurance, and using European language, into the ORSAs of insurers. And third is disclosure of risks. Initially, of course, using the TCFD of the FSB and supporting of that. And now most big jurisdictions and international standard setting bodies are also supporting the efforts of the ISSB on disclosure. So these are very common elements across supervisors. The IIS in particular has also written application papers, which is our equivalent of guidance, that incorporate these expectations across the insurance core principles, which are the broad supervisory principles that all supervisors are expected to follow, and they get assessed through IMF assessments and so forth. Now, the next step is to try to build tools that will enable both supervisors and also, of course, in cooperation with the industry, to enable good scenario testing. Given the uncertainties I've described earlier in my talk and that others have described, traditional stress testing techniques are not easily replicable. But however, scenario testing, which is explicitly more forward-looking over longer horizons, is applicable. We have applied it in the Bank of England. We did an exercise this year. It was a very useful exercise, not least in determining capability gaps and data gaps, and focusing on areas where the industry is, some in the industry are good at, some others are less good at, and finding also broader gaps. I mean, the results suggest that climate risks are going to be a permanent drag in profitability of around 10 to 15%. And obviously, their drag is worse under the worst scenarios. And we have tried to do similar exercises at the global level at the IIS. So these are the efforts. We're now pushing forward with filling in data gaps, as I explained earlier, and with a scenario testing work. Let me stop here. Thanks.
Thanks so much, Vicky. Martin, the first question for you today, not necessarily an easy one, perhaps in recognition to what has been said so far. It's not, assessing climate risk, even through stress testing, is not the easiest thing, especially because it does not concern one specific time period, and then definitely it does not concern only one sector. The European Commission announced that it will be mandating the ESAs and asking the ECB to run a one-off climate stress test. What can you share with us about these plans and the progress made so far?
Thank you very much, Dimitri, for inviting me to join this distinguished panel. And let me also thank you, Pamela, Petra, and the EIOPA team for all the very good work that you are doing on sustainable finance. Maybe before I answer your question, let me just say a few words about the context, about this exercise, how it fits into a broader strategy, our vision for addressing all the major challenges that colleagues have already explained so well. As you know, improving the financial sector's resilience has always been one of the key pillars or goals of the agenda since the very onset of the project back in 2018. We had this action plan where we have clearly said that we expect a lot from the financial sectors, from the supervisor, to improve the resilience of the individual institutions, but also to improve the resilience of the whole system at the systemic level. Now, a lot of things have been done over the last 4 or 5 years, but we thought that we need to shift the gear to a higher speed, especially when it comes to resilience. And that was one of the reasons why last year we have adopted a new strategy on sustainable finance, where we have clearly underlined the importance of improving resilience further. But then, it's not enough to only say headlines, it's important to improve resilience. There are really important actions on the ground that need to be taken. And in the subheading on managing sustainability risks at the system level, we had been much clearer and much more detailed about what we expect to happen. So there we have said that we would certainly need to improve the identification, measurement, and management of risks at the system level. we would need to strengthen the cooperation between the Commission, the policymakers, with the European supervisors, the ECB, with Paul Steam, the ESRB, with the aim of capturing, monitoring, and mitigating all systemic sustainability risks that would ultimately impact long-term financial stability. And Paul has been always very clear that these risks are coming, they are pretty much certain, and the impact of those risks actually will only get worse. So we have, in this particular section of the strategy, we said that in order to achieve this goal, we will really need to intensify the work to develop coherent and relevant methodologies and scenarios to quantify sustainability risks and to stress test the resilience of the financial system as a whole. We have obviously already introduced several requirements for the banks, for insurance companies. There are several stress tests also at the supervisory level, but they are kind of in silos. So one of the key actions in this particular section was that the Commission committed to mandate a targeted stress testing of the financial system as a whole on the Fit for 55 package. And here, I mean, of course, we would not do it alone as the Commission. We would clearly rely on the excellent work of the ESAS, ECB, and the ESRB. So over the last couple of months, we had extensive discussions with the colleagues from the ESAS, from the ECB, the ESRB on how to design and implement this exercise. And my team, actually, as we speak, we are finalizing a formal mandate that we hope that the Commission can dispatch formally, officially early next year. And this exercise, again, should complement the different already existing stress testing activities, the regular ones, and also the climate-related ones. The purpose of this exercise would be to provide us with a better understanding of how the financial system under stress could jeopardize the achievement of our emission reduction targets for 2030, and of course, how we can respond to such a situation if such a scenario materializes. Maybe also on the rational, I mean, as you know, we do expect the financial sector to do a lot in terms of filling the investment gap that we have. I mean, the ambitions of the European Green Deal goals are very high. The same goes for Fit for 55, and that requires huge investments throughout the whole financial system. Now, the public sector will never be enough, and the bulk of this gap will have to come from the private sources. And we are now intensifying our work on monitoring capital flows into sustainable economic activities, but this is a very much backward-looking exercise, even if we get the most timely data. So the purpose of this exercise is to have a forward-looking perspective. This is, again, one of the very powerful forward-looking tools. We need to anticipate, we need to be prepared better to react quickly to possible disruptions in the flow of finance. So we need to do this exercise quickly. I mean, the goal that we have on our side is to get the results and possible advice on the kind of outcomes of this exercise at the latest by the beginning of the next Commission's mandate, which basically coincides with the end of 2024. Again, all the details will still need to be fleshed out, but I just would like to again comment all the work that colleagues at the ESAS, ECB, and the ESRB have done already on this with us, and we will keep you posted on the announcement once it's ready.
Thanks, Martin. We're all holding our breath on that. Let's now go on the next question, which will be for you, Paul. Talking about stress testing, the ESRB has also employed various NGFS-based scenarios covering banks, funds, and the insurance sector. What can you share with us when it comes to the results of these exercises?
Thanks, Dimitris. Yeah, so as you're probably aware, for our sins, the ECB has inherited the NGFS scenario design custodianship from the Bank of England, who did an outstanding job over the last years in establishing these as a consistent way to view the climate transition over the long term. And in this liaison with natural science, people involved in natural science, environmental scientists, with whom we don't normally interact. And I think it's been ultra helpful to have a consistent lexicon through which we can view and frame the adjustment. Now, with this in mind, I think what we've done on our end is very much a complement to the work of Vicky and colleagues on the bottom-up side with their CBEDs at the Bank of England, or the ACPR, what they did in France. And we have also tried to run top-down analogs on this side. Top-down in the sense, if you run models, you don't consult with the institutions themselves, but rather to see from a holistic point of view. With some of the details, of course, you have to gloss over what might be some of the lessons we can take away. I think in thinking about preparing, I had 4 key things I thought it would be important to emphasize here. So I think the first is really granularity. The second is horizon. The third is about dynamics and interactions. And the fourth is about uncertainty. And let me talk about each quickly in turn. So in the side of granularity, I think what we realize is focusing on headline numbers sometimes is a bit misleading because a lot is going on beneath the surface. So I spoke earlier about this idea of Schumpeterian dynamics. I think what's true is you're going to see in the transition a lot of sectoral variation in terms of outcomes. And what we saw is, you could see elements where you have corporate defaults in 2050 around 13 to 20% lower, but huge shocks for fossil fuel producers if we are to look at a disorderly transition in particular, less so in an orderly transition, where you'd have transition and physical risk really interacting. We could have even up 40, 50% losses for fossil fuel producers' output. So clearly, I mean, these are going to be things we have to be thinking about in terms of granularity and that devil in the details. On the side of transition risk, of course, economic sectors and firms. On the side of physical risk, really about geographies. After, I think, granularity, the second thing, which is, I think I'm going in level of complexity, which is higher, is horizon. So I think Vicky noted it is important to retool the models we use, the perspectives we have, to deal with questions about intertemporal trade-offs and longer horizons. We're not normally accustomed to dealing with risk management for the system, either at the level of institution or at the level of stress testing. And I think here, of course, what we've found thus far is that there's this element of physical risk, transition risk trade-offs, whereby in around a decade's time, so early 2030s, physical risk starts to become dominant and start to be really, really costly. But in the meantime, there's no question, there's intertemporal trade-offs. There's upfront costs in the form of transition risk for longer dated benefits in the form of physical risk. And there's a societal altruism or sort of policymaker altruism needs which follow. And I think that's not an easy one to tackle. So we're really looking at, in terms of working with the scenarios at shorter horizons, actionable horizons, what's important there. Because, as John Lennon said, life is what happens when you're making other plans. A lot to think about in a transition. So after, again, granularity, horizon, then I think the next thing is about dynamics. So I think what we've been doing thus far is really about static stress test applications. So we fix the behaviors of firms, insurance companies, investment funds, and banks. And we see how the system evolves as you move along. Of course, that's a very, very fanciful assumption, particularly over long horizons. You'd think there'd be a lot of dynamics within sectors. So of course, you'll have near-term measures to try and stop losses or strategic adaptation, which goes along the way, but also between sectors. And I think this is where our work has tried to really focus. Could you have also the elements of banks, which are providing loans to insurers, to funds, or the securities holdings, which are cross holdings, important in dictating how market risk shocks in particular might play out. And we saw, indeed, there could be huge amplifications from the collective interplay of trying to dispose of or acquire securities at the same time within the financial system. And I think the fourth and last point is really about uncertainty. I mean, it is as you move out in the future, error bands naturally start to get much larger. I think our intention with scenario analysis, and I think Vicky hinted at this too, is move away from uncertainty to more probabilistic risk. Can we have a view in terms of what might be some bookends in terms of scenarios and how that complex interplay along the way can make this, of course, hard to judge, but you can build in some sort of range of possible outcomes and think about within the climate space, the macroeconomic space, and a financial space, how you can actually measure these shocks. And I think this is our current and ongoing work, model adaptation, making sure that's there. But in the meantime, I think we already have a solid foundational basis to say how and when risks will materialize, likely market risk followed by credit risk, and where they will be distributed in the system, probably insurers, investment funds likely up front with these market shocks given their balance sheets, and banks more on the side of credit risk, seeing this sort of insidious pop-up of, say, credit risk along the transition as we move along. So I think a lot is there, and we're also learning, I think, in many respects.
Paul, I check with Pamela if you can have one more hour to discuss within our panel. She just replied no. So I will have one question more, which will be for you, Martin, when it comes to what can we do, when it comes to any kind of policy actions, any kind of to-dos. If you could tell us a bit more about the Commission's work on climate strategy, perhaps to bring it more concretely, in your view, what is needed from private and public sectors to achieve an effective transition and reduce some of the risks we have been discussing so far?
Thank you, Dimitri. I think that we will need 2 hours, not 1 hour. Your question is actually very broad. Maybe let me say a few words about what is expected and what is needed from the public sector, and then I will go into the private sector. I mean, because this agenda on sustainable finance is mainly about the private sector. But the role of the policymakers here, of the Commission, is to provide a clear framework, provide direction of travel, provide a target, which I think we have under the European Green Deal target. We have a net zero target by 2050. We have the Fit for 55. And obviously our role is to provide a clear framework that would facilitate the transition. And that's exactly what we are doing in the area of sustainable finance, to support the financial sector, to support the businesses, not only on the transition pathways, but also to manage the risks. Here we are talking about the double materiality concept. Let me say that it has been already mentioned that for us, this is really the heart of our strategy. We should not be talking only about the risks that climate change and environmental degradation have on the financial sector and the businesses, but we do need to talk about the impact of the financial sector and the businesses on climate and environment. And we believe that the latter will ultimately influence and inform the former. So that's why, of course, we are very active at the international level. We are trying to achieve as much alignment and convergence, but we cannot compromise on this kind of two-channel approach in managing risks and ultimately being on track with meeting these ambitious targets. Now, the transition, I think, is the key word here. We have to have a proper discussion on the right pace. I mean, how we phase in green, how we phase in sustainable investments, and at the same time, how we kind of phase out the harm investments, how we make sure that the risks are properly managed. And I think that we do need to have a better and deeper conversation here, not only with the sector itself, but also with supervisory authorities, with the central banks. So there is a hint to these conversations already in our strategy, and we will focus on that next year. Now, what we expect the financial sector to do now is that they will actually start using some of the tools that we have been putting forward together with the supervisors to manage the risks, but also to help them to get into the green aligned space with these ambitious targets. As you know, our approach has so far been focusing on transparency. All these legislative pieces that we have put forward in the area of sustainable finance are essentially mandating better transparency about who is doing what and how, and of course managing the risks. That's what we have done in mainstreaming sustainability considerations in the CRD, in the Solvency II framework, and that's also where the work of the ESAs is so important. But now, the framework is more than the compliance with the regulatory requirements. We do believe that the financial sector ultimately has to do much more on their own to get there where they should be. I mean, ultimately, so that the goals can be met by everyone. And this is where the Commission now has publicly announced that we will focus on the implementation and the support of the usability of the whole framework on sustainable finance in the next year, because we are now entering a phase where a lot of things have been done, but now we are a little bit also in the hands of the sector, because there is nowhere in the financial acquis now requiring insurance companies or banks to invest in particular assets or to divest from particular assets. But we do need to have a conversation how this transition will ultimately be done. What are the plans? I mean, we are having clear requirements for transition planning. We need to make sure that these transition plans are credible, they are implemented properly, and how the supervisors together with policymakers can, again, have a proper conversation with the sector about the right pace. So I think that there is a lot of big space, I think, that we have to occupy next year. The focus on implementation, usability, and making sure that this framework works not only in terms of regulatory compliance, but ultimately enabling the financial sector to transition properly and smoothly is really key of the agenda. I think that I will stop here. Thank you.
Thanks so much. Perhaps I think, well, we have less than 10 minutes. Actually, 6 minutes. Pamela, I will turn back to you. Do we have any questions from the audience? Any question for our panel members? I think this is a unique opportunity to address the panel members. So is there any question that I should transfer to our... Yeah, good.
Yes, Dimitris, there are more questions that you may wish for, and I'll start with a quite tricky one, actually. And it might be political, and it might be very much focused on what the industry is doing. So maybe Renaud or Martin, you may want to say something. There is a lot of speak of net zero strategies. Renaud, as leading the net zero insurance underwriting strategy. So what do you think, or do you have a view on the potential impact of these net zero underwriting or investing strategies, A, on the insurers' portfolios, the diversification, and B, what would be the impact at macroeconomic level? Because you see that some economic activities may run out of insurance. And then another question linked to that is, are we then putting ourselves at a disadvantage in competitive terms during the transition? So it's a bit cheeky, but relevant.
As soon as I heard the word tricky in your mouth, I knew that you were about to direct the question to me. But actually, I think it's not a tricky question. It's a great question, but I will still keep it and address it. I'm not only for the tricky part. I mean, it's really to the point, and it does have a direct impact on our portfolio that we can already track. We took commitments on the investment side a bit early on, both at the AXA level and more broadly in the industry through the Net Zero Asset Owner Alliance. And you can already see, the shape of our portfolio evolving. And the same is starting to be felt through the Net Zero Insurance Alliance, which I personally chair. And we don't believe it will be a challenge for diversification as long as we work supporting the transition of the underlying economy. And I think that what has caught the eye in the first steps of these efforts, both on the investment side and on the underwriting side, were exclusions. But exclusions are, only actually a measure of last resort for hopeless causes. And this is why, for instance, at AXA, we were a pioneer and we were the first insurer to divest from coal in 2015. And we did the same starting, exiting coal underwriting from 2017, because by design, you can't decarbonize coal. It's a hopeless cause. But exclusions are only, a small part of what we can achieve. And I would like to make sure we address, that misperception. They are not the core to our strategy. And we have many other levers to pull through client engagement and through helping our clients, be they corporates or households, actually transition to make sure that they can have a lower footprint. And to do so, and to be very practical and concrete, focused on action here, this is why the NZIA has just delivered something which is extremely foundational through a tie-up with a partnership for carbon accounting financials, which is the first ever standard to measure insurance-associated greenhouse gases emissions. And it's meant to be universal. What I really appreciate is that obviously it becomes the Net Zero Insurance Alliance standard, but it's also taken up by insurers which are not yet members of the Net Zero Insurance Alliance. And by design, we believe that we will improve things as soon as we can start to measure them. And so this is a very important first step, but definitely not, standing in the way of diversification, because we believe that all segments in the economy will be able to transition and to improve their footprint.
This gives me just 2 minutes to try to summarize. Pamela, next time we have this panel, I think we need 2 hours, not only one. Let me just try to summarize, or at least pinpoint some of the topics we discussed, and I think it's worth following up. Let's say in a nutshell here, climate change will affect the whole balance sheet of the insurance sector, both looking at the asset, also the liability side. What is different, what is unusual is the time horizon. So this is an unusual time horizon when it comes to assessing risks, both at the supervisor side, but mostly also on the industry side, making also historical data less relevant, because we are used in looking at the past to predict the future. This will not be the case going forward, especially when it comes to climate change. Now, when it comes to assessing the risk at different parts of the world, we'll see that although the commitment may be there are different levels of understanding and different levels of bringing tangible terms when it comes to this commitment in different parts of the world. And this is something to keep in our minds going forward. When it comes to the relevance of the insurance sector is there to smooth losses going forward, but there is the question of when it comes to the losses incurred by the insurance sector, well, this will lead to an increase in the protection gap going forward and the trade-off between transition risk and physical risk. Need for international cooperation and the role for the IAS or relevant bodies when it comes to supervisory convergence, but not only supervisory convergence, because also the private sector has a role to play there when it comes to converging in risk assessment and looking at the financial system as a whole. Policy action going forward, what we can do as the supervisory community is definitely help in assessing the risk, help in assessing awareness, and enabling what we call this transition process into a more green economy. So looking at my time, 1 minute late, and I'm going back to you, Pamela. And with a big thanks to our panel members. As I said, I would love to have 1 more hour to the minimum to discuss with you.
Thank you.
Thank you, dear panel. Thanks, Dimitris, you're the best. This was a great panel, and I hope we can continue this discussion also without the conference and maybe live. So enjoy the rest of the morning. And with this, we are at our first coffee break, our first real coffee break. We missed one, so it's well deserved. The coffee break will end at 11:25 Frankfurt time. So please refresh and then be prepared also to submit questions and actively participate in the next 2 regulatory panels on IOPS and on Solvency II. Stay tuned. Thank you. So, dear audience, welcome back after a healthy and revigorating coffee break. We will be continuing our event with 2 regulatory presentations, and the first one will be on the EIOPA's fiduciary duty in light of sustainability considerations. It is part of the discussion in the review of the EIOPA 2 directive, and for this I would like to invite Brendan Kennedy to join the floor. Brendan is the pension regulator and chief executive of the Pensions Authority in Ireland. Brendan, very welcome and happy to have you here. The floor is yours.
Thank you, Pamela, and good morning, everybody. There's a lot going on, and it's very welcome to the opportunity to address this conference. So, right. My objective this morning is to look at the challenges created for those running EIOPs. I'm going to call them managers, different terms in different countries, but let's call them EIOP managers. And I want to look at the challenges when they are allowed or required to take account of sustainability considerations within the context of their fiduciary duty to run their EIOP. I will start with the disclaimer to echo what Pamela just said. EIOPA is working on the response to the Commission's call for advice in relation to a review of the EIOPA 2 directive, and sustainability is one of the 6 topics raised in the call for advice. Important to say that no decisions have been made about EIOPA's response, and what I'm saying here this morning is a personal view and not in any way an EIOPA view. Some EU legislation defines sustainability as the whole range of environmental, social and governance issues, but I'm going to focus more this morning on environmental and in particular climate issues. However, I think the points I make have a wider application to ESG matters as well. I'm going to identify what I see as some of the practical challenges and problems which are created by applying sustainability considerations into the fiduciary management of EIOPs. However, it's very important to say that I'm going to be talking about challenges, I'm going to be talking about difficulties. What I am not trying to do is argue against the inclusion of sustainability. Rather, what we need to do is to identify and try to resolve those challenges in order to achieve the objectives. One very important issue for EIOPs, and it's throughout the discussion, it's really important to bear it in mind that although there are a number of very large EIOPs, most EIOPs are small or medium entities and they have limited resources. So issues which are challenging enough for the financial services industry are especially difficult for many EIOPs. And in any discussion of bringing sustainability considerations into EIOP, into the EIOP duties, we have to bear in mind the specific challenges represented to these small and medium-sized entities. Let me start with the definition. What I mean by sustainability considerations is not just explicitly incorporating financially material, climate and environmental factors into investment analysis. In my own view, this falls within the definition of ordinary fiduciary duty in any case. Now, what I'm addressing is the familiar double materiality. In other words, taking account also of the costs and benefits of climate or environmental externalities created by the assets in which the EIOP invests. And I'm making 2 assumptions. The first assumption is that incorporating double materiality increases the risk of lower returns. It's a risk, not a certainty. It's obviously, as we all know, possible that future events mean that such a portfolio won't result in lower returns. For instance, in the event of high carbon pricing or a disorderly transition that leads to carbon assets becoming stranded, or an accelerated energy transition which increases the value of renewable energy assets. But these are optimistic, these are maybe best case scenarios And we have to recognise that sustainability considerations in investment may result in lower returns. And it's that, within the context of fiduciary duty, that is the challenge for managers. Excuse me. The second assumption is that sustainability considerations are not a simple yes or no decision. Managers have to decide not just whether to take sustainability considerations into account, but how much and what approach to take. Looking at fiduciary duty, long before sustainability considerations were considered, fiduciary duty has always been a very demanding obligation. Fiduciary duty arises when somebody has the responsibility for making financial decisions on behalf of somebody else. And because the future obviously can't be known, you can't create a set of rules that can be mechanically applied in all circumstances. So fiduciary duty is therefore a framework or a set of principles within which managers are required and expected to apply their judgment. And actually, managers are required to make two judgments. What is the best interest of the members and beneficiaries, and what actions should managers be taking to achieve that best interest? It's a responsibility that is and was demanding in itself long before we start to think about sustainability considerations. And in my view, the most important issue is not that sustainability considerations are at odds with fiduciary duty. To the extent that there is a potential conflict, that can be and should be addressed through clear, unambiguous legislation, which removes or would remove any potential uncertainty from managers. No, in my view, this is a complexity and information problem, much more than a legal issue. The problem is that fiduciary duty is a challenging responsibility, and sustainability considerations make it even more challenging than it already is. Managers already have the responsibility of deciding the appropriate balance between risk and returns. It's a familiar problem, although that doesn't mean it's an easy problem. What sustainability considerations do is they add a third and maybe even a fourth dimension to that responsibility, so that the judgment of risk and returns and the criteria against which managers have to judge them become more complex and less linear. So the two challenges of sustainability considerations for IORP managers are, firstly, how to decide what's the right amount of sustainability considerations, and then having decided how to achieve it. And the challenge for those who supervise IORPs is to assess how well they're doing. In the first place, IORP managers need to decide how much sustainability is enough. Is there such thing as too much sustainability? There probably is. But certainly for many people think there's such a thing as too little sustainability. But we also have to recognise that there's no simplistic measure of sustainability. Rather, there's a range of ways of thinking about sustainability. There's a range of potential targets. There are considerations. And all of these different ways of considering and measuring and targeting sustainability are not necessarily compatible with each other. One possibility is, of course, to ask the IORP's members. But that's not straightforward, obviously. How well do members understand the possible trade-offs? Would the answer be dependent on how the question is asked? What if members don't answer? What if only some of them answer? What if different classes of members give different answers? So unless legislation is very prescriptive, and I don't see how it can be, managers are going to have to use their own judgment about the extent of sustainability or the sustainability targets they set. And of course, fiduciary duty, as I said, always involves judgment. But the judgment involved in sustainability issues is new, it's unfamiliar, and it's changing for most, if not all, IORP managers. And then once the decision about the degree of sustainability is made, there's a considerable challenge to give effect to it. There's no common reliable measure. There's no single framework for action. Managers have to decide where to direct their investments based on some hopefully coherent model of how this will contribute to sustainability goals. And within their chosen model, they need information to translate those goals into meaningful practice. I think this is my most important slide. Applying sustainability requires judgment, and judgment has to be based on reliable, usable information. Sorry about that. IORP managers, bearing in mind the size of them, IORP managers can't simply decide what information they want and then expect to find it easily in the market. Because for all but the largest IORPs, IORP managers are information takers. They have to work with what information the market provides to them rather. And making sure that reliable, meaningful and usable information is available must be a legislative priority. And of particular concern is model risk. As we all know, there are considerable differences between the sustainability ratings of different rating bodies. And in one way, this reflects reality. It reflects the differences in opinion and methodology that exist, but we're not seeing a false consensus. However, if IORP managers are going to rely on these sustainability ratings, the ratings are going to have a considerable impact on the investment allocation of IORPs, based on what, at the end of the day, are subjective views of the relative sustainability credentials of different assets. And if there are only a small number of ratings used, these subjective judgments are going to have a very significant impact on markets. And if there are a large number of ratings to choose from, it's going to be really difficult for IORP managers to choose among them. And that choice is going to be a very significant choice. After the financial crisis, there was understandable concern about over-reliability on the credit rating agencies. We need to find a way to avoid similar issues arising with sustainability. But at the end of the day, IORP managers are going to have to choose, and they're going to have to rely on one or more of the ratings available. It's not going to be easy for them to make that decision. Many of these issues exist because applying sustainability considerations to investment at scale is still very new. We have very little knowledge, experience, or data, but we don't have the luxury of taking a long time to figure all this out. There is obviously a considerable amount of work being done to address these issues by many organizations at many levels. These include governments, regulators, and international bodies, academics, NGOs, international networks and initiatives, and drawing on different kinds of commercial and technical experience, which means there are resources for IORP managers to draw on, but they have to identify the ones that are appropriate for them. And that in itself is going to be a very significant challenge. And they also have to accept the fact that models and best practice are going to change over time, and probably quite rapidly over time, as we all learn. The most important point I want to make, though, this morning is that the obligations imposed on IORPs through European and national legislation must be examined from the perspective of those who have to apply them. We must not underestimate the complexity or how big a burden the task we're going to impose, or probably going to impose, on IORP managers is. It's relatively easy to articulate principles that have broad support and which are designed to achieve worthwhile objectives. That's not particularly difficult. But what must not be overlooked is the question of how they are applied in practice. Are they too vague? Are they aspirational rather than practical? Are they measurable? But at the same time, what we don't want to do is to tell managers that they should wait until it's all been sorted out, until every challenge has been addressed before they do anything. We don't have that kind of time. And in all of this, regulators, legislators, supervisors face the familiar challenge of achieving that balance of protecting members and beneficiaries without being too prescriptive, without stifling innovation, and without distorting behaviour. It's not legislators' job to run IORPs, that's the manager's job. But we can play our part in supporting IORP managers to play their part in advancing sustainability goals. Let me summarize in the following 2 slides. The question that managers need to answer in order to apply sustainability considerations within the framework of fiduciary duty are: how much sustainability? How to do it? What information do they need to apply it? And how do they deal with the changes and the developments that will inevitably happen over time? And the question that legislators and supervisors need to answer in order to apply sustainability considerations are: how can they implement a practical system that takes account of real-world challenges that I've just set out? Back in 1970, Milton Friedman, the famous economist, wrote that famous article which was to define, I suppose, an investment era. His proposition was that the only purpose of business is to make profit. And he elevated, I suppose, the concept of shareholder value as the dominant consideration for investors and for managers. And the big advantage of that view was that it simplified business decisions. It made life a lot simpler than it would otherwise have been. The problem, obviously, as we all know, was that it ignored and ignores environmental and social costs. It ignored externalities. And that era is now over. But to paraphrase Antonio Gramsci, quite what will replace it has not yet been determined. So we've a lot of work to do. Thank you very much for listening. I look forward to the discussion.
Thank you very much, Brendan. Again, another very inspirational sharing of thoughts, and it has stirred quite a number of comments in the chat. So Brendan, if you allow me, I'd like to ask you 1 or 2 questions following your intervention. One is, I think, from an IORP member who may not feel he or she, or it has been heard quite recently on sustainability preferences, because the question is actually, how are IORPs actually going to collect the sustainability preferences of members? Or what are the tools, the practices, and what if they don't collect or they don't receive the right responses? What is your best way forward to actually allow the IORP manager to form his own judgment? Because as we understood, there's a new level of judgment required, and there's a lot of uncertainty and a lot of dynamics, which requires the managers to adapt. But how can we help them then objectivize these decisions for a type of stakeholders which has a very different interest than a usual shareholder, as you said at the end? So how can you collect sustainability preference in an IORP?
I think most of the answers I'm going to give to the points that are raised are not going to be answers, because my view of where we're at is that we've a lot of thinking to do in very short terms, and it's much more important that we identify the questions before we inevitably try to decide what are the most practical answers. I think the issue of collecting the views of members is really, really important. But among the challenges are, it's necessary for the managers of an IORP to have a coherent view themselves before they're in a position to frame the question for their members. So I think phase 1 is, do the managers themselves, have they framed, if the decision was up to the managers themselves, are they sufficiently sure that they understand the trade-offs, that they understand the choices available to them, that they understand the range of actions they can take? Because until they're coherent about that, they can't ask coherent questions. As I said in my remarks, it is very difficult because the I think the way the question is going to be asked of members is enormously important. It also, I think, is going to depend a lot on both on national practices, maybe national laws, but also on the specific design of the IOPS, the extent to which member considerations can or must be taken into account.
But definitely a dialogue will be needed also. And the core is indeed to first identify a good question. And I know it's tough enough during such. But then do you think, Brendan, as a follow-up question from the audience, do you think that the prudent person rule gives guidance to an IOP to formulating these questions, to actually bring its fiduciary duty to the next level? Is the prudent person rule still useful and relevant in guiding an IOP's decisions or investment strategy in the sustainable finance context?
I think the prudent person rule is still relevant, insofar as we all know, the prudent person rule is what investment decision would a reasonable, prudent person make. I think sustainability increases the number of factors that have to be taken into account. So I think what sustainability does is it makes the operation of the prudent person rule more complicated, because you don't just think simplistically of what's the best investment return I can achieve given my risk tolerance. You have, as I said, it adds a different dimension. How do I balance the risk, my investment return, my risk tolerance, with sustainability considerations? So I don't think the prudent person rule gives any guidance in how to do it. I think obviously the prudent person rule has to be at the center of the manager's decisions. But sorry, I'm not going to have any optimistic answers. This is really hard.
Yes, indeed. And we did introduce in the Solvency II in the insurance regulation, as part of the prudent person principle, the duty for insurers to actually take into account the impact of their investments on sustainability considerations. But we are still forming our expectations on that and how the industry is actually also trying to implement that. And that is not a lack of guidance, but the guidance is forming itself also on how to form the judgment. Then I sense from your answers also, Brendan, you said pessimistic, optimistic. We do need to be realistic, I think, because we all need to form good decisions here. But what is then, do you think, the single, if there is one single biggest challenge to implementing sustainability in the IOPS framework and in the operations of IOPS?
I think the single biggest challenge is we need to think ourselves as IOP managers. Let us assume that all the guidance and laws and so forth have been put in place and that there is now a legal framework. Sustainability considerations must be in place. I think the single biggest question is, if I am an IOP manager and next Monday I have to go in to start work and say, okay, the law is now there, what do I do? I think we have to help, and I don't mean in a directive way, but there has to be this understanding of the steps that need to be taken by our managers to give effect to this. I think perhaps at a national, at industry level, at professional association level, there needs to be discussion of how implementation what it will actually look like. I don't want to, as you say, for insurance, for many areas of finance, the principles are, I think, being finalized very quickly. My concern is the gap between principles and what people are expected to do. And I think it would be useful to have workshops, to have discussions about this. We're far too early in our experiences of these issues to be able to say definitively this is right and that is wrong. But over time, I think our understanding will improve and the range will narrow. But we need to share experiences. We need to operationalize the work required to put these principles into practice and to decide what at least is acceptable.
Indeed, thanks, Brendan. So it is indeed creating awareness, maybe also part of not financial literacy, but sustainability literacy, which I think comes from both sides. And only then you can engage also on, how do you say, at par, or then you can really have an engagement with an IOP and its members. Now, I don't think that's a fair question, but what if a member of an IOP doesn't want to pursue sustainable savings or sustainable investment strategy? I think that's almost a no-go question, but how much leeway is there then for, once you have the regulatory incentives and the drive to have sustainable investments, can you still choose? That's a politically incorrect question.
It is a political question. I don't think it's an incorrect question. I think it's a very important question. But I think, to be a bit unsympathetic, IORPs exist within a framework. IORPs are vehicles for retirement saving. Members may not like the way their retirement saving is managed for a variety of reasons. They may like more risk, they may like less risk, but IORPs in the main don't allow an infinite choice to members. There are constraints existing. So it may be that an IORP or national laws would allow members to opt out, but if they don't, there are other things that members don't have choices about. So, those are just
what's
rules.
different?
Yeah.
Now, I'm really stretching you, and I would save it for one last question, Brendan. There's a lot coming in. Is it also relevant to consider whether there is a difference between defined benefit and defined contribution pension schemes? Do you think sustainability considerations should or can be taken into account differently?
I think the biggest difference between defined contribution and defined benefit that occurs to me is that there is more scope to allow for member decisions within defined contribution. It would obviously be possible in a defined benefit scheme to survey the views of members, but if the employer in a defined benefit scheme, in defined benefit IORP rather, is paying the balance of cost, I'm not sure how possible it is to take account of the views of members in deciding the sustainability effect, because I'm not saying sustainability should be ignored. I wouldn't agree with that personally, but to the extent that sustainability considerations do end up reducing the return, it is the employer probably who is going to have to pay that additional cost. So I think member considerations are probably less important, or there's less scope to take them into account in defined benefit than there would be in defined contribution.
I think that's a very fair answer, and indeed, we see that we're not at the end yet of the discussion. So, Brendan, you are currently reviewing with the team, with the member states. You are reviewing the IORP2 directive, and we wish you all good luck on that. And I hope also you will get some feedback and maybe inspiration from this panel, from this conference. Thank you very much, Brendan, and best regards to Ireland.
Thank you, Pamela. Thank you.
So, dear audience, we're moving to our second presentation, and I'm sure Brendan has given you a lot to chew on, but also on the do actually sustainable investments give a better return? And I think this is very timely and a good leeway into the next topic. Before we, I would also already like to invite maybe Fabian on the floor. Fabian, but we will first announce a short poll while I will be introducing you. Fabian, you have a few questions to the audience, and I think my colleague has already launched a poll. Just as a kind reminder, keep sending your questions also via Slido. So do answer this poll. And I'm sure there will be plenty of questions on Fabian's presentation. So as a short introduction, I welcome Fabian Regle. He's expert on sustainable finance in EIOPA's policy department, and he will be presenting to you our latest discussions on the insurance regulatory framework for sustainability, risks and factors. And I know, Fabian, you can't see the poll yet. So the question is it time for dedicated prudential treatment of climate-related transition risks in Solvency II's capital requirements for market risks? So it's already quite an advanced question for a very advanced topic. Now I see we're getting a few comments, and at the same time, I would like to give the opportunity to participants. I know it's a tricky question, and Fabian has been occupied with this topic for quite a few months. So what do we see? Yes and no, but the main question is why or what depends on how the prudential treatment falls. Yes? Oh, Fabian, I don't know. You can see the Slido. I don't know if it gives you great comfort in your future work. The floor is yours.
Yeah, thank you very much, Pamela. Yeah, I can see I have seen the poll, and I think it shows quite well the current status of the debate on this. So I think something around the 50-50 split is basically a good mirror of the current debate. And I would say it also underlines that it's now the right time to open this discussion from a prudential perspective and to discuss with you, with the public, this topic. Do we need dedicated treatments or not? What is the evidence? What can we do here? And we have already heard a lot of very interesting comments, discussions in the morning, and now it's my turn to talk to you about exactly this topic, the prudential treatment of sustainability risk. So when we think of sustainability risk, I think it is fair to say that these can have material and far-reaching implications on the investment and underwriting activities of insurance companies. When we take, for example, climate change, then we are discussing a lot about transition risks related to the real economy's decarbonization pathway, and that these transition risks could potentially materialize in financial losses. When we think of the underwriting side, we there already see a substantial increase in claim payments related to net cat exposures, because we see and also expect for the future a material increase in the frequency and the intensity of climate and extreme weather related events. So I think we have a clear setting on the example of climate change that it can have material implications. But there is, of course, or there are, of course, many more aspects when it comes to sustainability risks. So we have heard nice comments on discussions about social objectives, social risks, and so on. So it's really a broad topic, which makes it super interesting, but also very challenging to discuss and think about this from a prudential perspective. So when we take Solvency II as our framework here, then, of course, it is important that Solvency II, with its risk-based and forward-looking characteristics, reflects sustainability risk in an appropriate way. And this also by taking into account the unique role of insurers they have as financial investors, where they invest a lot of money, but also as the society's risk managers, where they underwrite all the risks and through that contribute to the economic and social welfare. So This is an important aspect to take into account when discussing sustainability risks. And the question that actually arises in this context is the current framework adequate to do so, to reflect sustainability risks appropriately, or do we perhaps need some specific adjustments? And here we have published, I think on Monday, our discussion paper on the prudential treatment of sustainability risks. In this discussion paper, we show the methodologies and the data sources we want to implement for assessing the potential for having a prudential or a dedicated prudential treatment of certain sustainability related aspects. So this discussion paper is basically our first deliverable in response to the proposed Solvency II review mandate, what requires EIOPA to actually have a look on this. And we want to follow a step-by-step approach, which means that we first published this discussion paper to engage with you in the public discussions. What are the best approaches? What are the best data sources to study the question? And also then, after the discussion paper, to work on the empirical side, to make the analysis to see what or to what extent do sustainability risks drive prudential risk? And do we need a dedicated treatment? And if so, what would be then the policy implications? How could that look like? So that would be the second step of this step-by-step approach at a later stage. Now, this slide gives you a quick overview of the discussion paper and its main content. So we have basically three large areas in there. So we have the first area, assets and transition risk exposures. The second area, there we look on the liability side, on the underwriting activities of insurers, in particular with a focus on climate change adaptation as environmental objective. And the third area is about the social objectives, and there we take a holistic perspective in the sense that we look at the assets and the liabilities of the insurer's balance sheet. The paper itself is a relatively long document, so I cannot go in every detail, but I try in the next slides to give you a quick overview about the key steps and the key approaches that we plan to do for the analysis. So let's start with the first section, the asset side. So the risk-based logic for this is basically that climate change mitigation is one of the most important or urgent environmental objectives we have for the moment. And climate change mitigation requires a substantial and quick decarbonization of the real economy. So we need substantial and massive emission cuts, and that ideally immediately. So for firms that are unable to adapt quickly and fundamentally their business model to this new transition pathway of the real economy, we could expect that the externalities they create through their behavior could materialize in the market values of the assets related to those firms. So this is the transition risk we are talking about. We have this environmental objective, reducing the climate change in the sense of the global temperature increase, requiring emission cuts, and those firms that do not behave in the sense of being aligned with this objective might be exposed to transition risk, as for example regulatory or market sentiment changes, and there could be then implications on their business models. We have also seen in the last couple of years a lot of improvements in the definitions of transition risk, in the definitions of the risk channels, how these externalities might materialize, get internalized, might lead to prudential risk. We have improvements in data availability, and also very important, we have a lot of evidence and research looking exactly at this question: to what extent does transition risk influence asset prices? So that's why we argue that it's now the right time to do, from a prudential perspective, a Pillar 1 related analysis in this regard, to do a quantitative analysis on the potential effect of transition risk on the solvency capital requirement for market risk in the Solvency II framework. Here on the on the right hand side, I try to give you a quick overview of the conceptual framework for the analysis we plan to do. So we basically look at 3 asset classes. We have the stocks, the bonds, and property, because these are also the main important asset classes for the insurance undertakings. And then what we consider very important is basically to have both the backward-looking perspective using historic time series data, but also the forward-looking perspective based on models and plausible assumptions, because the backward-looking perspective might not be fully informative about the potential materialization of climate change and transition risk into asset prices. That's why we argue it is important to have a look at forward-looking evidence and to take that into account, for example, to validate the historic findings, but also to enhance and enrich the evidence we see in the data. So this is basically the general framework for the analysis. And now when you want to assess the transition risk exposure of assets, there are basically 2 general approaches you can follow. So on the one hand, you can follow a sectoral approach that you take, or that you assume that the sectoral characteristics of an asset drive the transition risk exposure of the firms in these sectors. So you, in this approach, assume that basically every firm, every asset associated with a given sector has a similar exposure to transition risk. And you can, for example, use NACE codes for the classification of sectors. On the other hand, you could also take a firm level approach that you say the idiosyncratic characteristics of a firm are actually the driver for the transition risk exposure. And there you could, for example, use greenhouse gas emission levels as a determinant for transition risk. So we have these 2, I would say, general approaches, and we discuss them in more detail in the discussion paper with the pros and cons. And then if you have chosen such an approach, then of course you need to put all your data into the Solvency II calibration machinery with all the requirements on the risk measurement, like the value at risk and so on. And this, or there we also have a lot of details that we discuss in the paper, so that we have a very comprehensive perspective on the risk assessment for bonds and stocks. On property, we have a lot of literature arguing that the building's level of energy efficiency is a main determinant for transition risk exposure in the real estate markets. And there are a lot of good and plausible arguments in that regard, a lot of empirical analysis already done showing certain effects. And when you think about this, then what we propose to do is basically to use a building's energy performance certificate as an indicator for transition risk. And with that, you can, for example, try to create property indices or house price indices in relation to the different energy performance certificates or the different energy efficiency levels of the buildings. So for example, when we think of this A+ to H scheme, we could think of creating different indices and then to see if the relative difference in the level of the energy performance of the buildings might result in different levels of market values for the properties. And this could then translate into property risk from the Solvency II perspective. Now, when we come to the second part of the discussion paper, it is about the underwriting side, the underwriting activities of the insurers. And here, insurance undertakings can really make a unique contribution to especially to climate change adaptation, when we think of undertakings that have the expertise, that have the knowledge about modeling and pricing climate risk, and then also to give recommendation and advice to the policyholders, to the society, what to do to prevent and reduce risk exposures. And this is basically a bit the setting we are discussing in the discussion paper. So the rationale or the logic here is to say that we see already, and for the future, we can expect a material increase in the frequency, the intensity of climate-related events. So there's a lot of evidence out there. And this increases the risk base, the actuarial premium levels, at least for the non-life contracts that have coverage to net cat related loss events. And this creates then the threat that the threat to the medium and long-term affordability and availability of the insurance, of these insurance products to the society. And we already have a related insurance protection gap. So my colleague Marie will tell you more about this in the afternoon. So we have our dashboard, which shows there is a climate-related insurance protection gap. And we also already see some market friction in certain areas around the world. So that policyholders or consumers are no longer able to get some insurance coverage in especially disaster-prone areas. The famous example is the California insurance market when it comes to wildfire exposures. So what we argue is then, in this context, that climate change adaptation in terms of risk prevention is an environmental objective and can be a key tool to maintain the proper market functioning in the future, so that insurance coverage still remains available and affordable to the society. And the question we raise from the prudential perspective and we would like to answer is basically, what does that mean? What do adaptation measures with regard to underwriting risk from the prudential perspective? Is there an impact? And if so, what does that mean for premium risk, for reserve risk, for net cat risk in the Solvency II framework? So we want to study these effects. This here is a basically more technical description of what we mean when we talk about adaptation measures. So in essence, it tells you that we think of certain types of measures that can be implemented by the policyholder or by the insurance undertaking in advance to a loss event that actually reduce the frequency or the intensity of the expected damage. So more practical examples are anti-flood doors, shutters, sandbags, hail protection nets, early warning systems. All these kind of measures that have in common that they, of course, on the one hand, reduce risk exposures, but on the other hand, also are under the control of the policyholder or the insurance undertaking, because then you can implement those measures into the legal terms and conditions of an insurance contract. You cannot do this with public measures like dikes. So you have not the control over the government to implement a dike in a certain risk zone and then to make this as a requirement in the legal terms and conditions. And through climate change adaptation and the risk prevention, we then also have this risk-based link to the actuarial insurance premium and then to the Solvency II framework, which is then the basis for our prudential perspective and our prudential analysis. In the discussion paper, what we do is to set out and discuss the Pillar 1 hypothesis on the potential effect of adaptation measures on non-life underwriting risk. We particularly focus on premium risk as a starting point. We also include some case studies to show that to what extent are there effects on the risk exposures, what is a bit the basis in that sense. And we have already done a data collection earlier this year to collect data, especially for premium risk, to start the quantitative analysis. And now the last or the third part of the chapter, social objectives. We have already heard in the keynote speech very important arguments why social aspects matter. And from the from a prudential perspective, of course, these social risks and objectives can have material consequences on investment and underwriting activities of the insurance undertakings. For example, if we think of a firm that misbehaves from a social risk perspective or is not aligned with social objectives, then there can be financial losses or externalities that materialize in financial losses if an undertaking invests in those firms or underwrites risks related to those firms. So when we think of reputational losses, litigation expenses, and so on. So we have basically a relatively similar way of arguing that social risks matter and also can lead to financial losses for investors or underwriters. From the prudential perspective, what we consider important is basically to say that a social risk, or the S in the ESG, should have a conceptually similar treatment like the E in the ESG. But of course, we have to consider the conceptual differences that exist. For example, you cannot really use a scenario analysis on social risks, at least for the moment. And we should also, or need to, consider the different pace in the public debate about social risks and social objectives. For example, we still do not have any consensus on what exactly are social objectives, what exactly are social risks. So there's a lot of work going on, for example, at the European level, but there's not yet such a commonly agreed framework that makes it easier to argue about the quantitative effects. So what we propose to do is to follow a gradual approach, that we say we start doing our analysis here with the Pillar 2 and the Pillar 3 requirements in Solvency II. So we look at the risk management and on the disclosure requirements. When there will be the time when there is more consensus and so on, then of course you can think about doing some Pillar 1 related work. But for the moment, we argue that we should start looking at Pillar 2 and Pillar 3. Besides doing this prudential work or the prudential analysis, one of the major aims of our work in this chapter is to initiate the discussions around this topic, especially from the prudential perspective, and to identify a bit the key areas that can be or should be focused on for our future work. So we want to initiate and foster a bit discussions with you. What should we do about social risks from the insurance perspective and insurance regulatory perspective? What we do in the discussion paper is that we come up with some working definitions for social risks and objectives. So we take into account all the public debates we have at the moment on this topic. We try to map a bit how social risk can translate into prudential risk. So we give some clear examples, which is also shown a bit here in this figure on the right-hand side with the typical Solvency II risk categories. And then we discuss a bit how can social risk materialize as prudential risk. And then, of course, we discuss the Pillar 2 and Pillar 3 related aspects in context of social risks and objectives. Yeah, so this is already the end of this very quick journey through the discussion paper. So we have a lot of material in there, a lot of detailed discussions. Please share with us your opinion, your ideas, your evidence, whatever you want to share with us on this. I think it is clear that this is a very important and far-reaching topic. So it is necessary that we discuss in detail what you think, what we think, and then find the best way on doing the analysis. You can use, for example, or not for example, you can use the EU survey tool for sharing the comments with us until the 5th of March. So please use the tool. We have 82 very specific and detailed questions that we consider worth and valuable to improve the analysis. Of course, we do not expect you to answer all questions. So please select only those questions that you would like to answer and then let us know through the tool what your responses are. So I would say that's it from my side. Thank you all for listening, and then back to Pamela.
Thank you much, Fabian. Now, I would be interested to see how the poll results look like after people will have read your paper. So maybe we can do that again after the consultation. Plenty of questions, actually, and 5 minutes left. Maybe one more methodological or even a higher level question. As capital requirements are actually aimed to cover unexpected losses, and here we're talking about capital charges, one of the participants asks, aren't all risks already actually covered sufficiently in the technical provisions? So actually, this is a question, why aren't we maybe looking, and the question is, are they? Well, yes, no. Is there somewhere also considerations about looking at the valuation approaches of technical provisions, and that's maybe consideration for later. I don't know if you want to take that up, but it's just a remark I saw in the chat. Fabian.
Yeah, thank you. It's a very good remark, also very complex and complicated remark. So in the discussion paper itself, we do not discuss the technical provisions. Of course, you could, for example, argue that if anything is known about climate change, that basically nothing is known when it comes to the materialization, because we already know that we can expect a lot of unprecedented events to happen in the future when it comes, for example, to physical risk and so on. So it's, I would say, really hard to argue that everything is already priced in or valued on the balance sheet. And this is indeed an area when you think we should pay more attention to it, then let us know through the EU survey tool, and we are happy to discuss this in more detail.
Yes, indeed. We're looking forward to receiving useful inputs on that. And then, of course, a lot of questions on data, Fabian. I'm not going to ask you to solve them or to respond to them all, but for example, do we have enough data to assess the impact of climate change on credit risk, on counterparty default risk in Solvency II terms? How are we taking into account the importance of risk zoning also in assessing the risks to which property is exposed? How can we use that type of data into forming capital requirements? And another question, I'm not sure if this then also links, if you use greenhouse gas emissions or the energy efficiency of properties, I mean, do we also think of second order effects, or how you deal with all these kind of data related issues? So there are limits to data. Maybe generally you can assess a bit.
Of course, data is the basis for all the analysis. We need good and more data, and this is also part of EIOPA's sustainable work program, that we improve, at least on the underwriting side, the data situation. When it comes to especially the asset side, when there was a remark with credit risk, we do not look at credit risk in this discussion paper, so we focus on market risks. Of course, data availability is always an issue. I would say it is even more complicated to get appropriate data on the real estate market. So if you have good ideas to get data there that also tracks then the energy level of properties, these are very welcome, that we can include that into our analysis. Risk zoning and all these related aspects, yeah, indeed, I would say, especially the physical perspective of climate change, the physical risk exposure is an area where definitely need more improvements in the data availability. So I would say on the transition risk perspective, we have more data when it comes to emission scopes and so on. There are a lot of improvements, but especially on the physical risk side, it's really a bottleneck, because in the end you would need very granular spatial data. You would need the address of a property, of a firm's buildings. You would need also knowledge about if a firm has risk mitigation measures, like insurance contracts that potentially reduce or compensate for any damages, and then reduce the impact on the cash flows that could materialize in the asset prices. So there are a lot of requirements and wish lists we have on the data side. So yeah, it's generally a bottleneck, I would say, but we can be optimistic. A lot of improvements have been done in the future, and we can expect, for example, at the European level, that more and better data will be available with all the disclosure requirements we have in place.
Now, I'm aware that the time is all actually over, but just one comment and maybe one question to also share them with the audience. So I think on the underwriting side, one member of the audience asked, are you actually reviewing the impact of loss prevention measures, or who should be in the lead? Is it a prudential, a supervisory perspective? Is it the government? Is it actually the private insurance sector who should be doing that? So I think that's maybe a pense bête. I mean, and maybe we will see more of that next year also, following work we've done on impact underwriting, maybe, Fabian, but it's indeed a good question. Who is actually going to measure all this? And then I think a final question, and that's then the question whether these prudential requirements would make a difference if higher capital requirements would exist. Example, for fossil fuel assets. Would it actually deter insurers' investment in fossil fuels? I don't know if you or me can say that, but I think that's actually the ultimate question. Why are we doing this, right, Fabian?
Exactly. So on the first part, who should supervise or assess that, the effect of adaptation measures? So I think what supervisors can do, or the prudential perspective can do, is to raise the awareness, to give evidence, to give examples. What are adaptation measures? How can they be implemented? And then it's on the industry to implement those in the contracts. I would not say that we necessarily need some kind of watchdog about adaptation measures. I think if they are successfully implemented in insurance products, then there will be, in that sense, kind of natural market pressure to follow up on adaptation in insurance. So I would say that's not necessarily the need to have a watchdog. Regarding the implications on the investment, I think this will be part of our analysis when we do the quantitative work. And I would say it is a very complicated answer or to formulate any expectation, because you should think of undertakings. It's not only the capital requirements that are the determinant for the investment decision. When we think of cash flow or duration matching, these are also very important aspects for the investment behavior of undertakings. So we need to see, when we do the analysis, what comes out, what could be risk differentials, if there are any, and then to exactly discuss what could be the implications on the investment activities. We should definitely discuss this.
Thank you, Fabian. So to all, please contribute to the discussion by answering the survey. It's online by the 5th of March, and we will see more of this, I'm sure, in the coming months. Thank you, Fabian, and good luck. So here we are. We've arrived at, I think it's our lunch break. And we have a lunch break until 13:30, so 1:30 Frankfurt time. And we hope to continue to see you back for another very, very actually innovative and very insightful afternoon. We will discuss greenwashing in a panel. And we will have some more technological insights on how we can actually promote prevention measures, adaptation, and how we can address protection gaps by an impulse talk and a presentation by EIOPA and Professor Bresch from Zurich. So I hope to see you all numerously, and enjoy your lunch break. Good afternoon, dear audience, and welcome back to our Sustainable Finance Conference at EIOPA. I hope you have enjoyed your lunch break and you could refresh, because we have a very interesting afternoon and we need all your attention. Just as a kind reminder, you are very much invited to send your questions via Slido, #EIOPA. We try to deal with all questions, but as you've realized, we have so many questions coming in that we have to select a bit. But please do not hesitate to send your questions. So next on the agenda, we have an impulse talk, and an impulse talk is really, the aim is to get you thinking and to maybe reach also some frontiers of your thinking or of your practices. And we've invited Lynn Kaag, who is Assistant Professor of Computer Science and Public Policy at the Hertie School. So I would like to invite Lynn to share with us her ideas on the use of artificial intelligence for climate change mitigation and adaptation. Lynn, the floor is yours.
Thank you so much. Let me share my screen. Okay, is this good?
Excellent.
Okay, great. Thank you. Thank you so much for the invitation. So my talk today will focus on how we can use AI and machine learning for climate change mitigation and adaptation. And I'm going to take a particular focus on climate risks. So what are maybe emergent technology or effects on emerging technology on climate adaptation to physical risks. And I also wanted to talk about a project on financial disclosures really briefly. So before I dive in, I just wanted to address a little bit more what we actually mean by machine learning, which is a subfield of AI. And it's probably the fastest growing subfield of AI. And therefore, I'm almost going to use AI and machine learning as synonyms in this talk. So with machine learning, we mean a group of techniques that can automatically extract patterns from large amounts of data. And there is a way to illustrate what it does compared to conventional computer systems that I like very much. So in conventional algorithms, for example, a simulation, what we do is we input data to the computer and a function. So we already understand how the data links to the outputs that we want, and we program that into the computer. And then the computer system gives us the output data. So machine learning works differently. So here we give input and output data, and we give a guess of a model type. So for example, a neural network. And then the computer learns the function. So we don't input the function. Instead, the computer essentially learns and outputs the function from the input and output data. So it's a fundamentally different regime that we're talking about in terms of how computer system works and also of the capabilities. And some main areas that you hear a lot is supervised learning, where we actually have labeled data. So we have the two main regimes, regression and classification here. Then we have unsupervised learning, where we just try to detect patterns in unlabeled data, so no annotations. And then there's reinforcement learning, where one tries to learn policies or try to play games, essentially. A few years ago, I wrote a very comprehensive long paper together with a number of other authors, where we looked at how we can use machine learning to address climate change, both or in climate science, mitigation and adaptation. So how we can reduce greenhouse gas emissions and also how we can adapt to a changing climate. And we found really many different kinds of applications that can be relevant here or that are already being deployed. And I wanted to walk us through some recurring themes that we identify here, and also name a few examples that could be relevant if we think about the financial sector and how the economy is evolving. So probably a lot most talked about is the ability of machine learning to improve forecasting. So here we can, for example, improve the integration of renewable energy into the power grid by forecasting better the output of renewable energy, such as solar and wind. but also we can improve transportation systems by forecasting the transportation demand, and there are many more applications that have to do with forecasting. Another area is improving the operational efficiency of systems. And what I mean with that is, for example, using AI in systems that control, for example, heating and cooling in houses or in industrial complexes. So here actually AI manages to leverage much more detailed input features and have a more fine-grained control of these systems, and therefore also saving energy. It can also be applied to save food waste, for example, by more closely controlling the system, the supply chain of food. And then there's this area of accelerating scientific experimentation. So not only in energy, also, for example, in medical applications, pharma or chemical operations, machine learning is being used to essentially propose new experiments that seem very promising and therefore speed up the experimental process in the lab. And this can be used, these kind of mechanisms can be used to develop better batteries or develop materials for next generation solar panels, for example, so new clean energy materials. I wanted to dive a little bit more into this example of battery research. So essentially, battery electric storage is a key building block of decarbonization, and we're still in the need of reducing the costs of batteries and improving their performance. So this research and development, R&D in the battery industry is really essential for energy transitions. And AI is being used for targeted experimentation for next generation batteries. So identify new materials for these batteries, but it's also being used to understand better how batteries degrade, for example. So this is a really important area for innovation. Then the next theme I wanted to talk about is predictive maintenance. This is something that is currently already done in industry quite a bit, and it can also help to address climate change. So, for example, if we're able to identify natural gas leaks, then that helps with mitigation, but also if we're able to create more resilient infrastructure by detecting faults early, this helps to adapt to a changing climate. And I wanted to walk us through an example of the maintenance of rail systems. So rail systems are critical to decarbonizing both the passenger and freight transportation systems. And predictive maintenance here can actually help to increase the competitiveness of these systems. So for example, by preventing failures and reducing the need for costly repairs. And essentially the idea is here, if something fails, it's much more costly than if you prevent it from failing in the first place. And I think we all have been bothered by train delays before, and the less these occur, the more likely we are to choose rail over road transportation. So choose a train over a car. And that, of course, helps with addressing climate change. So AI can be useful here in analyzing large amounts of sensor data, and it's able to detect anomalies that could be indicative of failures in the future. And you can see here on the right an example from the Deutsche Bahn, where they are using these technologies to analyze sensor data from railroad switches to understand better where failures might occur. And then there's a whole area for machine learning applications in large-scale simulations. And this can be applied in climate science, but also in things like city planning, where you have large simulations of wind flowing through cities, or even in engineering applications of vehicles. So this is an example from climate science. Essentially, here the idea is that we need to model the climate and especially how it changes. And these are important tools for local and national governments that need to predict the impacts of a changing climate. Extreme events is just an example of such impacts. And we want to be able to predict accurately what are the climate impacts on a localized way to determine also the appropriate adaptation measures for these impacts. So we want to understand where there's excessive rainfall, where there are floods, where there are droughts, and so on. And currently the problem is that climate models are really low resolution. So we're usually modeling very large regions, and we need to downscale them to smaller regions to make these predictions more localized and to really have actionable information. The problem here is that they are so time intensive to run that you cannot really easily make them more fine-grained. And the way that machine learning and AI are used here is that you're actually approximating parts of the models or integrating machine learning with these simulations in order to downscale them to localized predictions. So you can actually speed up time-intensive simulations considerably by approximating parts of the model with a neural network, for example. And the last theme that we found is gathering information. So here you use data sets that previously couldn't be analyzed with without machine learning because you had to manually scan them, for example. And now you can use machine learning to perform certain tasks in them, and you can actually extract useful and decision-relevant information. So you can understand, for example, from satellite images, you can build infrastructure data sets, or you can understand where greenhouse gas emission sources are. So an example here is on using satellite images is this example, how to improve food security. So the problem is that climate change has large impacts on agriculture due to droughts, excessive rainfall, pests that change because of the temperature changes, for example. So overall, we have the whole sector is very sensitive to the changing climate, essentially. And here there's a need to monitor these crop yields at scale to inform farming practices, but also to inform emergency response. So you can actually understand when there's a threat of a large-scale crop failure in a certain region due to extreme events. And machine learning is being used, or in particular computer vision here is being used to automatically label crops over a wide area using those satellite images, and therefore having really timely information about the health of the agricultural sector in a region. So there are many more application areas that have to do with satellite images, but I wanted to just briefly dive into another example using not images, but text as data. This is another example of gathering information from large-scale unstructured sources. And this is an example to analyze corporate climate risk disclosures. It's from my own research. And as you are maybe well aware, there are large financial implications of both the physical risks of a changing climate, but also transition risks due to decarbonization measures and a changing market. But there are also opportunities. What we did here is mostly focusing on risks. And many investors look at the annual reports by companies. And we were interested in the question of how much are companies mentioning climate risks in those annual reports, and is that changing over time? In particular, in the future, we'd be interested in understanding if policies have an effect on how these change over time. So what we did is we used natural language processing to automatically analyze the text in those annual reports and identify here on the right that the mentions per report are increasing quite a bit. So specifically, we used machine learning to read through 5,000 annual reports over the past 20 years and determine both the place, the number of mentions where they're talking about climate risks, and the type of risks. And then we were able to create this figure that I just showed you, and which is here on the right, that looks at the average number of mentions per report. And we did this by labeling our own training data here. So these training data are not usually available. So you first have to label a few paragraphs or quite a few paragraphs in those annual reports and then train your algorithm on this. And by having this analysis at scale, you can actually then look if there are differences across industries that are shown here. For example, you can see that the energy sector is talking quite a bit more about transition risks than other sectors. And you can also understand what are the differences, for example, across countries. So I wanted to finish with some considerations and caveats that I've outlined some of the ways that AI can be helpful. I think this is important to actually also frame the discussion more broadly. So even though there are quite a few application areas where AI is helpful, many strategies don't need the technology at all. So it's really specific problems, complex functions, large data sets where machine learning is helpful. And where it's helpful is often just one piece of the puzzle. So we need to integrate it with existing processes, and we need to really embed it in the institutional structures as well. And it's probably just one little building block of the solution. Also to note, machine learning can be outperformed by simpler methods as well. So it's always important to test it and to compare it to simpler methods, such as logistic regression, for example. And lastly, machine learning is intrinsically, of course, neither good nor bad. And there are also negative applications that really increase emissions. And I've recently published a paper also on the overall impacts of machine learning. If you're interested in that, I encourage you to look into this. It's still a beginning, but we're starting to understand also what are the overall impacts of the technology. And I just put here my contact information. Thank you very much for inviting me.
Thank you very much, Lynn. Well, for an impulse talk, it was really giving a lot of impulses. I see we also have a little bit run over time, but nevertheless, there's one question that, one observation and one question, just to know, also to note that you are indeed the founder of the AI for Global Climate Cooperation. And I think this is definitely also one of the areas where we see the recent climate resilience dialogue that has been set up by the Commission, where NGOs, supervisors, industry, and so come together. And I think that's definitely an area where such intelligence, use of data, making sense of data and patterns can really feed into a broader environment of policy making, because that's eventually what you're striving for, is that by making sense of data, there's better actionable decision making, right? That there are better policy decisions. But then my question would be, how much does this feed already into supervisory activity? Maybe you're not so familiar with that, but in regulator. So have you seen how is this being translated into real policy making, into Commission papers, into maybe EIOPA papers? How can we benefit from this kind of subtech on a daily basis? How accessible is it?
Yeah, it's a very good question. It's a more broad question. How much is government actually already using machine learning and AI, even generally? there are quite a few applications that often have to do with either scientific research, let's say detecting the water or trying to predict the groundwater levels and things like that, do inform policy making indirectly, but are more on the scientific side. Also, the whole remote sensing area, I think it's pretty advanced, but it's unclear to me how much that then features into daily decision making. And then there are areas where government is really still at the beginnings. And there have been also prominent failures of government trying to implement such machine learning systems for their decision making, and actually introducing quite some bias and issues in the decision making. So I think this is an evolving area. There's quite a lot of potential, but we are in the beginning, and I think we need also more experts on machine learning that are willing to work in the public sector, in government, to make this a tool that's helpful for decision making.
Lynn, thank you very, very much. And my conclusion is we should see more of you. So I hope you stay close to also what we're doing, and we hope to see you again very soon. Thank you very much, Lynn.
Thank you.
Bye-bye. Then going on to our next topic, we would like to first introduce a short poll to see whether the audience has already a few ideas on how to address insurance protection gaps for natural catastrophes. And while the poll is running, I see it is running, I will also briefly introduce my colleague Marie Scholler. Marie Scholler is Senior Expert on Sustainable Finance in EIOPA's Policy Department. And she will be joined after her presentation by, in a conversation, by David Bresch, who is Professor for Weather and Climate Risks at the Swiss Federal Institute of Technology, known as ETH Zurich. And I see the poll is running, and I think we have come across already enough, well, a lot of topics that touch on protection gaps, Marie. But the question is, which tools would you consider to be the most useful to address the insurance protection gap for natural catastrophes? And it's no surprise, thanks to Lynn's introduction, we see a lot of modeling, a lot of AI, but it's also not a surprise that we put you in the same area, because there is indeed a little bit of a scientific approach to protection gaps, but not only that. So without taking much more time from your presentation, you see the dashboard. Somebody is promoting your deliverable, Marie. So please, you can reflect on the cloud, but you can also start your presentation. The floor is yours.
Perfect. Thanks a lot, Pamela. Good afternoon, everyone. And indeed, I think from the pool is very interesting. I mean, indeed, we are going to talk about dashboard in this coming presentation about data. So I think we are on the right track, I think, at least for this audience. So just give me a second. I will share my presentation. Perfect. So we are here now going to discuss the insurance protection gap for natural catastrophes. So at EIOPA, we want to address insurance protection gap. And why? Well, because we have been looking at historical loss data, and we could see that about only a quarter of losses were insured in the past. And this really shows that there is a significant insurance protection gap. In addition, if you think of climate change, I mean, we have heard it already a couple of times this morning. I mean, this will also increase frequency, intensity of event, and will just widen further the existing protection gap if no measures are taken. So this is why at EIOPA we are really active to look into the insurance protection gap for natural catastrophe. So my first slide is going to look at how to address the protection gap. We are working on 4 different pillars. The first pillar, and I think this reflects again what we have seen in the pool, is really we first need to understand what are we talking about. We need to understand what is the current insurance protection gap for natural catastrophes. How do we do that? Well, we need to get model and we need to get access to data. This is really key. The second pillar is going to be to mitigate the risk. And this is really central. Any solution to address the protection gap should capture a pillar to look into mitigating your risk, because you need to address the causes of climate change and you need to adapt to the risk. And this is really a must. And this is also why at EIOPA we are putting a lot of efforts into that. The third pillar is to cover. We are looking into the insurance protection gap. So we also need to look at insurance coverages. We don't need to have 100% insurance penetration, but we need to think of optimal insurance coverages. And we will also go into that in this presentation. And the last pillar, but not the least, is really, now you have a risk, but you also need to think, how can I transfer this risk? We look into climate change. This is a huge topic for our society, and we can't say, okay, just the private sector will be able to address this. We need to have more and more public-private partnerships, and both need to work together to be able to address the insurance protection gap for natural catastrophes. So let's move on to the first. This is to understand the protection gap. So to better understand the protection gap at EIOPA, we have developed an insurance protection gap dashboard that you can see here. This is just a screenshot. This dashboard has just been published yesterday on our website. So what does it show? Well, it shows the insurance protection gap for 30 European countries and for 5 different perils. So we are looking at coastal flood, windstorm, wildfire, earthquake, and pluvial and fluvial flood. And we have different views. We have a current view, which is using a modeling approach. So we worked with catastrophe models to estimate the current risk for each country and each peril. And we compared with estimation of the insurance penetration. And from that, we derived a current view of the protection gap. We also looked at a historical view. This is using historical loss data, and this can also complement the current view. And we also provide in this dashboard additional information on how natural catastrophes are insured in each country. Because in Europe, this is extremely diverse. Every country has its own way to insure natural catastrophes. Some countries have public-private partnerships, some others that just rely on the private system and so on. So it's extremely diverse. So in this dashboard, we also wanted to provide a view on that and more information to the user to be able to understand where the protection gap can be coming from. So this dashboard is really there to be able to raise awareness about this issue, to also promote a science-based approach, and also to be able to identify at-risk regions and also potential synergies between national policies to reduce the risk of natural catastrophe across borders in Europe. And I think this is also very important. I mean, this dashboard I mentioned has been published yesterday, but it's going to be a living tool. We are going to update this tool regularly because, of course, also in the coming future, we will see some changes that will need to be reflected in the dashboard. When we developed this dashboard, one key issue that we had was also to get access to the relevant data. And this leads me to my next slide. I mean, actually, it's really key to be able to model the risk in order to understand the insurance protection gap. And this is why one of EIOPA's key strategic areas on sustainable finance is to promote the use of open source models and data. I think we've seen from the pool, data and models, they are crucial to have a climate risk assessment for the supervisory community, for the insurance sector, or for anyone in general, the public sector in general. I mean, for example, for us at EIOPA, we need to run a lot of natural catastrophe risk assessment. I mean, for capital requirement calibration, for the dashboard I showed you before, for financial stability analysis, supervisory risk analysis, and so on. Also, in addition to that, I mean, we recently also published an opinion which looks into including climate change scenario into the insurance order. And there also, the main issue that we have depicted is also for the small and medium-sized companies to be able to find the right tools and data to do so. Actually, we also see that there are more and more tools, data which are available, developed currently. But it's still quite challenging to get access to the right tools and the right data. Sometimes you have some tools which are available open source, but also not so user-friendly. And on the other hand, you have some tools which are actually user-friendly, but then also quite expensive. So that's why at EIOPA, we have decided to test the use of an open source catastrophe model called Climada, which is developed by the ETH Zurich. And later, we will also have a discussion with David Bresch to discuss a bit more about this model. And what we have realized when we started to test this model, that it's not straightforward to be used. Actually, you really need to go in the code, and maybe not everyone is a coding expert. So that's why at EIOPA we have decided to create a graphical user interface to actually facilitate the use of such a model. And next year in Q2, we will have an event where we will make this interface available, open source, to anyone who would like to try to do his own natural catastrophe risk modeling. Finally, in the long term, I mean, we aim to support the modeling and the management of climate change risks by incentivizing, promoting open source models, but also by positioning ourselves as a relevant open source data hub and providing relevant aggregated data. Now let's move on to the second pillar. I said this second pillar is extremely central. It's about mitigating the risk. And we are looking here at the insurance protection gap. We could think, oh, maybe let's increase the insurance penetration. But no, first we need to look at the risk and how we can mitigate it, because it goes without saying that the best solution is to reduce the causes of climate change and also, well, unfortunately, adapt to its consequences. Now let me go a bit deeper in an example. Let's have a look at non-life products. I mean, non-life products, they typically have short-term duration of contracts, so 12 months. What does it mean? It means that if your risk is changing, if you have a risk-based premium, you can also adapt your premium. So if the risk is increasing, your premium will also increase annually. At some point, this will not be sustainable because it will become unaffordable. And then it will just widen further the existing protection gap. That's why it's extremely key to think of proactive measures on building vulnerability, to think about the localization of the exposure, and also to think about optimized insurance coverages. And this will all be part of a resilient society. And there, reinsurers, as society's risk manager, they have an important role. For example, they provide advices on adaptation measures to policyholders. And some are already doing that. And in our concept of impact underwriting, we actually want to capture the option for implementing climate change adaptation and or mitigation through pricing and underwriting. So in that regard, we are currently working on a report on the integration of climate change related adaptation measures in non-life insurance products. So we have two aims. The first one is actually to collect good underwriting practices. And we want to promote this further. I mean, how currently adaptation measures are taken into account in non-life insurance products. And the second part is also to look into how adaptation measures, they can be better reflected in the capital requirement for non-life underwriting risk insolvency. So this is for the mitigation part. Now, of course, we can move to the third pillar, which is also looking at how to cover the risk, because we are looking here at the insurance protection gap. And there, what EIOPA has been working on and will continue to work on is to look at the demand side issues. Why are people maybe not taking up insurance coverage? What is behind that? A first tendency, what EIOPA could see, is that consumers might sometimes tend to underestimate disasters. And then, of course, they don't see the benefit of paying for an insurance coverage because maybe it's for future risks. And that's why it's extremely key to actually raise awareness about the risk to the citizens in Europe. Another aspect also that is important, and also happens to myself sometimes, that you look at your insurance contract and you might not understand it very well. And then you also have expectations gap. And of course, this will be detrimental to consumers and also impact the trust in the insurance sector. And that's why also at EIOPA, we want to promote contract simplicity and also ensure that there is a customer-centric approach to the treatment of risk exclusions. And going now to the last pillar, which is also the need to transfer the risk. Also there, I mean, EIOPA has been active also in close collaboration with the ECB, looking at the macroeconomic impact of protection gap, also realizing the need to further develop also private insurance. But as already mentioned in my introductory slides, I mean, just the private sector alone, looking at the challenges coming ahead of us, we need to think more and more about public-private partnerships and how both we can work together to actually be able to address the coming challenges. So to conclude for my presentation today, I think there is no surprise, climate change is a growing risk for the insurance sector, but actually it creates also a lot of opportunities. I mean, for the insurance sector, for us as supervisors, to be part of the solution to address climate change risks. Data, innovation incentives is possible to help people and businesses to prepare for the future risk. So with that now, I would like to turn over to my colleague David, where we will have a couple of questions to discuss a bit further the development of open source models. Hello, David. Thanks a lot for joining us today. I think it's a great pleasure to have you on board. I mean, we have been collaborating quite a bit these last years, but I think now it's really the time also that we can explain a bit more about this open source CAT model. But maybe we can start with the first question to learn you a bit better. And I mean, actually, you've worked at 3 as Global Head of Sustainability. And then you have moved to academia in 2016, working on open source modeling of weather and climate risk. And this is a very interesting move. I mean, can you maybe tell us a bit more about your motivations?
Thanks, Marie. I hope you hear me well like this.
Yes, we can.
Thanks all for the kind invitation. And yes, indeed. I mean, after 16 years in reinsurance, many years as a developer of CAT models, the conceptual architect, and then bringing them to the fore in climate adaptation, especially in my role as head sustainability, looking at the economics of adaptation, I more and more learned these things have to be shared and open. So one reason to move was to really make sure I can further develop things in a truly open space, not to criticize one of the leading reinsurers. They have their strong reasons to do some of the things in the open and some of the things for their pricing, for example, in a commercial context. And the other piece was really curiosity, to just learn more about the issues, as you see, more deeply understanding risks, for example, that often it's not the model you build that makes the difference. It's the mental model you share that really brings people into the conversation.
Excellent. And why would you say open source CAT models so important? I mean, what are their specific contribution to what we should be doing?
I think it's 2 or 3. One is transparency, means also reproducibility in a strong scientific sense. So the model behind the prototype you've been shown is peer-reviewed. So not only the components of it, but also the engine, the conceptual piece has been looked at by many colleagues, and they said, makes kind of sense. And so that gives you some reassurance on it. So that's the transparency piece. The other one is the global applicability, because for many players in the field, it's not so easy to access a model, and some of the models provided by commercial entities are not globally either consistent or not globally available. So there's also this comprehensiveness of the approach, the ability to interact, to co-create, to collaborate. That's a very strong piece on it. And last but not least, I think it's the societal aspect. That open source model might find uses I cannot even think of myself. So that you build these models, you bring them out, give it to the community, and they will say, oh, I've never looked at that, but I might give it a try. So I very much embark also in my research in collaborations they emanate from conversations rather than from my diligent strategic planning. So I like that playful approach very much too.
Perfect. And what were the main challenges when developing open source CAT models?
At the start, it was easy. Because at the start, you put it on GitHub, you advertise a little bit, and then your research team is using it, you collaborate with 2-3 groups, and then the community starts to grow. So to manage to also to host that community, not least also to make sure you basically curate the data the model can use, you curate the code is quite an effort. And the real challenge is maintenance. I currently spend 1 FTE of my core funding just making sure the model runs every day on a new machine, and we retest with Jenkins and these integration tests and make sure it's all. So the core is like a commercial software, which is a challenge because some of my research colleagues say, oh, could I not twist it? Because it would be more fascinating to do it that way. So we do that in a branch, but then how to bring that branch back to the core, it's often quite deep conversations of which community we want to serve. But I have to say, I like these challenges because they also push us to make our science more, or even might I say, most relevant to society. And this is not writing papers. It's really making sure the insights we produce, the tools we produce are useful to a wider community. And you have to put something into that. So I'm up to this challenge.
Excellent. And now maybe a last question from my end. I mean, taking into account the climate change and the big challenges ahead of us, I mean, how do you think that EIOPA, as a European authority, and also national supervisors, they could provide additional support to insurers and consumers in the future?
I think number one, it's your convening power. I mean, you have a mission, and the mission is big, and it's really to protect consumer society, to strengthen societal resilience, for example, vis-a-vis natural catastrophes in a changing climate context. And in that context, transparency matters, sharing information matters, educating each other matters a lot, dialogue ultimately. So today's event is for me a kind of a poster child example of how you convene this community, and I hope that some discussions embark from this or spur from these insights, and that's probably your prominent role is that one. And then it's for the national insurers, the national regulators, and the national players in the financial marketplace to take that up. And as some said on the panel before lunch, the key thing is we really play into the same theme, that they make it interoperable. We make sure we don't overdo it in one place and have no clue in another place. So we have to find a balance of providing transparency too, but also there you have a role to play, to synchronize, synchronize some of these conversations. And with that, I'm really happy to be part of those, and a pleasure to be with you.
Excellent. Thanks a lot, David. And I hope we can continue to collaborate as we are doing so far.
Sure. Looking forward to it. Thanks, Marie.
Thank you, Marie. Thank you, David. And I think what we've seen is going from the academic approach to trying to really find solutions to improve risk awareness, and solutions for also incentivizing on risk prevention. So we've published a dashboard. Next year we will see the application to actually access the modeling of climate risks in Climata. So there are very practical solutions. Now that we're moving also into the next panel, which is more and more coming to the customers, because I think now we've seen the industry this morning, we've seen the Commission, we've seen now also the academic part, and we've seen the highly technical advanced discussions. But then my question would be, if you see all these models, what could be the next level of actually integrating open source and integrating really applications where a customer could benefit from, or a normal citizen? Because as a normal citizen, I even have difficulties of accessing an open source application. I wouldn't know what to do with the data. So how consumer friendly can such a development be to inform a consumer on his or her risk, on available prevention measures, and on financial impacts of not taking prevention measures, and then pairing it with insurance offers? So do you see, this is blue sky thinking, which I think after lunch with all these impulses, I would like Marie and David, your views on that. What would be really the next step for a customer to really bring this into life?
Marie, you want to go first, or?
No, go ahead, David.
Thanks. By coincidence, I yesterday hosted a talk by Kerry Emanuel, one of these eminent tropical cyclone researchers, recently emerited from MIT. And he mentioned an absolutely practical thing. And I can say so because we're operating in a European context and are not doing kind of advertisement. But Realtors.com, it's a US basically real estate appraisal company. they fully integrate the NatCat view in their assessment of properties. So you as a customer can go shop for houses and you see their flood exposure, you see what it might cost you annually, what it might cost you in the worst case. So it informs their customers about NatCat risk today and in future. It's quite an engine behind, and we're nowhere there in Europe. And the question is, to what extent do you have to do so in order to better understand? But it's fascinating as a kind of a showcase how you could deeply integrate NatCat modeling, so on this deep, very a good understanding of risk with the ultimate point where it comes to the decision: do I buy that property and at what price? And so they take it to that length, and it's worth learning from that example.
Yeah, maybe Pamela, if I can just add a few points. I think that's all the challenge is really how to bring it closer to the consumers, to the citizen. I mean, and I think this is extremely challenging because it's also a complex topic. I mean, as David mentioned, there are already around the world excellent examples. So in the US, where they put it on a real estate website, when if you want to buy a property, you can see, you know, just the level of flood risk, and also having a forward-looking approach to that, so that people, okay, they engage their entire family capital into that. They know what the risk is going to be for them in the next 20 years. And I think these are examples, and also for the insurance sector, we could also try to bring that closer to the consumer, that they understand, you know, with a simple sheet on natural catastrophe risk, what is my risk that I'm facing now? Why am I insuring this property, and what are the corresponding risks? And I think this we need to bring that closer to the people in general. That's a key next step for sure.
Great, we're pushing ahead. And then now that we have the mental model, you have the risk assessment, you have the prevention, you have the coverage, the transfer. Marie, last question. Is that model applicable to any other risk? Is that the way to go? Will that be our methodological approach to address protection gaps?
I think, I mean, Pamela, the principle or the 4 pillars that I presented today, I think they are applicable for any type of risk. I mean, they are very common principles, and indeed it should be a framework that helps to address protection gap with some specificities. I mean, also we had these papers around the pandemic, which were also on these 4 different pillars. I think these are all risks, and risk needs to be understood, risk needs to be mitigated, risk needs to be covered and then transferred. And I think this is applicable everywhere.
Do you agree, David? Are we missing any pillar?
No, spot on. I mean, Marie said it. It's a very generic approach. The devil is in the detail of the conversations. It's not a technical challenge. It's a challenge to understand each other. And that's for each risk yet another deep dialogue.
Yes, dialogue is the key word, and we stay in touch. I'm very happy to have been able to meet you, David, also on this panel, and we'll see more of you in the future. Marie, thank you very much for this presentation.
Thank you.
Thanks.
So one more coffee break before, and we will continue at 2:30. So we will reconvene and welcome our panel of the afternoon, and that will be led by Marco Traversa, and they will be discussing greenwashing. So we're getting closer to the customer, and we meet again at 2:30. Thank you very much. And last welcome to the audience for our final panel for this afternoon. We would like to remind you again of the opportunity to post questions via Slido, and would like also to ask you a question. So dear audience, we're starting an opportunity for you to answer the question, what in your view is contributing the most to greenwashing? And you have only 4 options. So if you have any other ideas, you can share them in the Q&A. And while we are collecting your views, please hashtag EIOPA. I would like to introduce you to the panel moderator of today's panel. Marco Traversa is senior expert in EIOPA's Conduct of Business Oversight Unit within EIOPA's Consumer Protection Department. And one of his major projects, which is running now, is actually responding to the Commission's call for advice on greenwashing. And that is one of the topics we will be discussing this afternoon. So Marco, I hand over to you for introducing your panel participants. Thank you.
Thanks a lot, Pamela, and good afternoon, ladies and gentlemen. So this morning we had a panel which looked at the impact of climate change on financial stability. And then throughout the day, we heard a number of speakers and a number of interventions looking at the interlinkages between the insurance sector and climate change. What we will be doing in this panel right now is exploring how the insurance sector can contribute to the transition towards a more sustainable economy. In fact, we believe that insurers have an important role to play by channeling consumer savings toward products with sustainability features and by adopting and integrating sustainability consideration into their underwriting practices. We're recently conducting a EU-wide Eurobarometer, which we will publish in January 2023, and this survey shows that 1/4 of European consumers have heard about products with sustainability features. We also observe that there is an increase in demand and offer for products with sustainability features, and more insurers are making relevant commitment to transition towards a more sustainable economy, what we call the net zero commitment. These are, of course, very welcome developments. However, with a complex regulatory framework which is rapidly evolving, there is an increasing risk that some of these claims might be considered unsubstantiated. And this can lead to reputational damage for providers, but also erode consumer confidence in the role which the insurance sector can play to transition towards a more sustainable economy. Consumer might also feel deceived into buying products not aligned with their sustainability preference, and also they might find it difficult to hold insurers accountable on their ESG commitments. For example, and possibly due to the complex regulatory framework, what we see is that 50% of European consumers, which were part of the Eurobarometer survey, find it difficult to know whether products with sustainability features have actual sustainability features. Providers are also more and more under scrutiny, and they can be impacted significantly by possible unsubstantiated claims. In fact, in the current regulatory framework, and considering there are no clear definitions and expectations, there is a risk that providers might be held accountable when they're actually not accountable. And because of this, what we observe is that unfortunately some providers are refraining from offering products with sustainability features. To address greenwashing, we see a number of initiatives. These include the SFDR and the underlying disclosure templates, the CSRD, the new IDD sustainability requirements, as well as the taxonomy regulation. And I'm joined today by 4 distinguished panelists to explore existing and potential greenwashing risks and measures put in place by different actors, consumers, industry, intermediaries, to prevent greenwashing. What we will also be exploring today is whether there are gaps in the regulatory framework and what other measures need to be put in place to address this risk. We will also focus on the role which different market participants play in preventing greenwashing and whether enough is being done. And finally, we will be looking at how different stakeholders understand greenwashing and its possible core features. So, thanks everybody for joining us today, and let me introduce the panel. Today I'm joined by Ms. Alexandra Palinska, the Executive Director at Eurosif. I'm joined by Mr. Thierry Philipponnat, the Chief Economist at Finance Watch, by Mr. Patrick Montagnier, the First Deputy Secretary General of the French Banking and Insurance Supervisory Authority, the Autorité de Contrôle Prudentiel et de Résolution in France, and by Katharina Richter, who is responsible for regulatory management and implementation of the EU Sustainable Finance Regulation Framework in the Allianz Group. So now, before moving on to the panel, let's look at what the audience has told us in terms of what is their view on what is contributing the most to greenwashing. So some interesting answers. Most of the audience believe that greenwashing occurs because there is lack of stricter rules on what constitutes a sustainable investment. This is followed by the complexity of the regulatory framework, and only a few of the respondents believe that there are limited supervisory powers for intervention that would prevent and limit greenwashing. So interesting answer, and perhaps the panelists can care to comment on these answers as I also asked them other question. And Katarina, maybe I'd like to begin with you today. And I was wondering if you could explore what, in your view and in Allianz view, is the role of the insurance industry, in particular insurance product manufacturer, in preventing greenwashing practices, and what challenges do you see for the industry?
Yeah, thank you, Marco. We also agree greenwashing risk is a concrete challenge and it needs to be addressed and tackled. And Allianz supports standards for clear, transparent and non-misleading communication on sustainability. And that, of course, includes that this communication should be fact-based, evidence-based and relate to science. However, as you rightfully said, we are in the beginning of a massive transition, and therefore it's a longer journey, and the framework that we have is still evolving, and rightfully so. It must further evolve, but also we cannot refrain from acting. And in this stretch, so to say, of having a framework designed in robust groundwork, we don't have the details yet as much as we would like to have them. And that is, of course, also a challenge for the role of a product manufacturer. So product development, and that is what you had asked for, firstly, in the insurance side, must reflect the needs of a defined target market. And these are first and foremost financial security needs. For customer groups with preferences for sustainability, providers must assess how to best integrate sustainability factors in addition to the overall product development. So it comes in addition to the primary financial risk that the customer needs to cover. And we shouldn't forget that to get the relation right. Preventing greenwashing risk requires to define robust internal guidance for product classification to be rolled out. And here, and I know that during the course of the day, the focus was on time to adapt. So the climate change adaptation was very much in focus. And that relates very much to the P&C product development arena. And here, I would say, from a regulatory framework, we are more advanced because the EU taxonomy already provides for a quite long list of criteria how P&C products should be built to reflect climate change adaptation. And there also, from a product manufacturer perspective, we can build internal criteria and guidance along these criteria. The situation is different for life asset products. So for insurance-based investment products or for per se investment products, as you also said in your introduction, the situation is much more challenging for a number of reasons. And let me just work on three. First, as you said, there is currently quite some ambiguity in the regulatory framework that we have. We all know the regulation is still evolving, but we also must admit that even when the industry asked the ESAs for clarification, the ESAs have sent a number of questions back to the Commission to really say, what do you intend, what do you mean with this regulation? And as said, we cannot stand still until we get these responses. The industry must start acting. And that is what I think there are many actors committed to contribute to climate change mitigation, adaptation, to build products that deliver on that purpose. However, we have to work with, let's say, interpreting the regulatory framework, applying state-of-the-art, let's say, jurisprudence, and with that, moving ahead. But it is a challenge because with that, the ambiguity is there and we have to dare to deal with that. Second, when we look on the variety of product types that integrate investment, we see that depending on how they are built, the challenge is different. When it comes to insurance-based investment products that are based on the general account, then the product provider, the insurer, can define allocate the assets and therefore steer the asset in a more sustainable way. On the other hand, when these are composed products, multi-option products, then the product provider would select asset managers and also potentially would select a range of target funds to make them an offer to the customers. However, the customer himself must choose the target funds, and it is on the asset manager side to define the concrete allocation of assets. And that brings us to the third challenge. The third challenge is how much do we know about investee companies, and how much do we know whether their economic activities qualify in line with the EU taxonomy, which is not yet complete. So here we have to deal with preliminary data, with incomplete data, and we all know this will evolve and improve over time. But at this point in time, there is, let's say, the work to interpret and to base actions on an incomplete framework and also not fully available data as we would love to have this. So let's work on that basis, and to deal with that ambiguity is, let's say, the situation not only product providers but all market participants are currently in.
Thanks a lot, Katharina. And if I can summarize your answer in a couple of words, it's ambiguity, lack of data, but need to go on and need to continue to provide product with sustainability features to meet customers' needs. And perhaps one quick question back to you, if you care to comment. Are you, as Allianz Group, putting any governance measure in place to face this ambiguity, to face this issue, to ensure that there are some checks internally? And in 30 seconds, if you could give an answer to that. And then perhaps also a quick reaction from Patrick, because Katharina mentioned multi-option products and some challenges thereof. And this is quite common in the French market. Maybe, Patrick, you can elaborate if you see some challenges on the supervisory side. Katharina and then Patrick, thanks.
So what we did in Allianz is indeed that we have set up a huge project where we, across all our units that offer IBITs in Europe, try to discuss these challenges and of course also share data and information. And that's more easy, as I said, for the general account, where Allianz has a very strict regime implemented, and where we can apply these criteria in a very consistent way. When it comes to the target fund selection and multi-option products, it is more difficult and it's more, I would say, vague, and I would really pass on the answer here to my fellow colleagues on the panel to share their views.
Patrick.
Okay, thank you, Marco, and thank you, Katharina. Indeed, you're right, Marco, that the MOPS is mainly the main product for life insurance in France. But in my view, as a CPR, MOPS by themselves don't create effectively a specific matter. In fact, it's true for all kind of life insurance product, and it could be true also for a pure unit-linked product without any complexity of the product by itself. So it's more for us the fact that we need to have first a good information of each vehicle UCITS invested in by the insurers, but also the way that the insurance are selling their product. It could be a direct selling by themselves, it could be a selling by some other channels, but in any case, the way we are building this confidence for consumers to have a clear explanation of what is could be seen as green as an insurance product is the main important aspect, whatever could be the product.
Thanks a lot, Patrick. A very useful answer. And now on to you, Thierry. So Katharina highlighted a number of challenges. She mainly focused on 3 challenges for the industry into ensuring that product with sustainability features have actually sustainability features. And I would be interested to hearing your views as a consumer representative, and also if you could possibly highlight what risks do you see for consumers in case the industry does not stick to their net zero commitment and/or they make unsubstantiated claims in relation to sustainability features of insurance-based investment products. But perhaps also as a consumer, before you dig into the answer, could you also give us what, in your view, is greenwashing? How do you see greenwashing as a consumer representative?
Thank you very much, Marco, and thank you for giving the opportunity to discuss and think together. If we start from your last question, what is greenwashing? I think it's useful to start there, because before we go into the discussion of this is greenwashing, this is not greenwashing, we need to know what we're talking about. And in my view, there's really 2 different conceptions of greenwashing. And we need to be very clear on that so that we can address the issues one by one, step by step. The first conception of greenwashing, first definition of greenwashing, is really, are financial institutions doing what they say they're doing? This is the first definition. Second definition of greenwashing, second conception of greenwashing is what they are doing impactful? Does it make a difference? And this is really not the same thing. One thing which is really important is that the first dimension of greenwashing, are financial institutions doing what they say they're doing, effectively, at the end of the day, is pretty traditional financial market stuff. And it is something that NCA's supervisors, we're with us today, Mr. Montagnier from ACPR, know perfectly well how to do. I mean, for a supervisor, checking that people actually do what they say they're doing is part of their, it's their DNA, it's their job. Well, it's part of their job. It's a fundamental part of the job. So I'm not saying that's easy, because you need to there's a lot of new things to put in place, but that's very, it's easy to conceive, and then you need to roll it out. The second dimension is, i.e., the fact that what is being done has an impact, is much more complex. It is much, much more complex. And I would really share the view expressed by Katharina on that subject. I mean, yeah, I agree. This is complex. If I linked immediately to one of your other questions, which is, what are consumers expecting and what is the risk? And I'm sure we'll come back to that, step by step during this exchange. Well, customers really assume that, of course, there is no lying or cheating of saying things that are not being done. So they take that for granted, I think, which is why we need supervisors to make sure it's the case. But let's assume, to make the discussion simpler, that that's done. But the real expectation from consumers is that basically, when a consumer, a retail investor, has some saving to invest in a so-called sustainable product, that person, I would say, as a citizen or as a citizen consumer, expects that his or her saving will have an impact, however modest, on the sustainability of the world. And that needs to be demonstrated. And that is not easy. And the risk, if we cannot, we collectively, as all the participants in that system, if we cannot demonstrate to that person that her or his saving contributes, even marginally, but does contribute to building the sustainability of the world, then there will be a loss of trust, a loss of confidence in the system. And we all know that finance is about trust. And if we lose the trust, we lose everything. So this is a very, very, very important topic if we want this whole sustainable finance agenda of the European Union to have any sense or to be useful. Because, if and investors, and that's a big risk today because there's a lot of talk about greenwashing, sometimes founded talk, sometimes less founded or excessive. But the fact is that for the non-specialist, if they start thinking, oh, all this is nonsense, they'll walk away and we will have lost our time. Now, as difficult as it may be to judge the impact for a number of reasons, A, this is not an exact science. B, this is work in progress. And C, and I don't know if Patrick Montagnier will contradict me on that, but I don't think that the best experts on the subject are not naturally employed by supervisors. The historic job of supervisors is something different. Of course, they're learning fast. Of course, they have a number, and I have the privilege of knowing quite a number of them, excellent minds working on it. But do they know everything on this? Of course not. So how can they do that job? Well, I think there's a number of avenues that can be explored for supervisors to check that. One of them is that.
Thanks. Maybe if I quickly interrupt you, and since you call on Patrick, and just first of all, for the definition of greenwashing, you would agree with the audience that at least for part one, definition one, supervisor have enough tool. But maybe Patrick, if you could care to comment on what Thierry said, and in particular, greenwashing is limited. ACPR has been quite active in this area. However, Thierry was also highlighting, and I stopped him before he was giving the answer, and I would first like your answer, and then maybe Thierry can comment on it. But do you think that you have enough tools to supervise and monitor greenwashing? And do you see any challenges as a traditional quote-unquote financial sector supervisor for this?
No, just I don't agree completely with everything that Thierry said. I do think that we have some people, and they are very, in fact, active in this field because it's very something which is very societal, in fact, if I can say. So among the people that we have hired among the last years, we have a lot of people which are very interested by working on this green economy. So it's something which is very important, and we have a multifaceted, if I can say, recruitment policy. Talking about tools, but I don't want, I could be long on that, Marco, so it could be very long, but clearly we can do a lot of things.
Don't worry, I will stop you if needed.
It's a beginning of the process only, and of course we have, like everybody, a journey just to understand better how it works. Well, it's not so simple, but we can do a lot of things. And for instance, the call for advice by the Commission will be also the occasion for all NCAs around the table of EIOPA to develop their ideas and to give a lot of answers for that. And it's just the beginning of the process, but even now we can have some very clear ideas what we don't want to see, at least. I don't know what is the best product, but I know what I don't want to see sold as a green label, if I can say.
Thanks, Patrick. And indeed, I think as supervisor, we tend to focus on the negative or what we don't like from the market. But I guess it also helps guiding the market towards making sure that their claims are substantiated in relation to product sustainability features. Thierry, maybe a quick reaction since you called on Patrick on whether the supervisor have enough, and you were proposing some solution. Maybe 30 seconds, your views on this.
Yeah, well, in 10 seconds, I completely agree with what Patrick just said. I mean, competence, yes, there is competence, and it's already a very, very good step that the supervisors know what they do not want to see. That's a very, very good first step. My point was that, judging on whether a financial product will actually contribute to reducing, say, CO2 emissions is difficult for anybody, even for the best brains. So I think the key here is two things, and I'll be 10 seconds on each of them, if you allow me. When we talk about net zero is a long definition of pluses and minuses. Basically, it's greenhouse gases emission less carbon capture, carbon offset, avoided emission, and then there is all the debates about intensity versus absolute emission, scope 3 and everything. I think supervisors need to give a very precise definition of what this is. Because until we have a precise definition, someone can say I'm net zero, which will mean something for someone and nothing for the next person. So we need to have definition. And then when we have a clear official definition, then supervisors can more easily, quote unquote, I'm not saying it's easy, but it's more easy, do their job. The other thing is we have something called the taxonomy of sustainable activities. However imperfect it is, let's not go into that debate, but it's a rigorous tool to assess what a sustainable economic activity is. Let's use it. Let us use it. You know, if you call yourself sustainable, that means that either you've reached the substantial contribution level today, I'm skipping all the other dimensions of the taxonomy, or you're on a transition to reach that substantial contribution at a certain point in time, and tell us that, you know, you're a cement producer and you will reach your substantial contribution level in 2030 or 2040, I'm making it up. And then I know why I'm bringing capital to you so that you can be on the transition pathway to reaching that substantial contribution level. And that would be a way, and I'll stop here, I know I'm being too long, avoid the, you know, transition is the objective, but transition washing is the next danger, the next topic after greenwashing, or it's another way of greenwashing. So, you know, taxonomy should be used as a transition tool to avoid greenwashing.
Thanks a lot, Thierry. And maybe Alexandra and Katerina, if I could just ask you, I have a question relating to regulatory framework in the second half of question. If you could just hold on to that thought that Thierry said, clear definition, clear targets. So later on, we will explore about principle-based versus more rule-based requirements. But before we move on to that session, maybe Alexandra, Katerina today has showed to us and told us what the industry is doing to prevent greenwashing. Patrick presented some of the challenges for supervisors, and Thierry also highlighted some of the risks for consumers. In your view, do you think that all market participants are doing enough? And if not, what more do you think we should be as market participants doing to prevent greenwashing?
Well, thank you for this interesting and challenging question, Marco. Look, whether the financial market participants are doing or not doing enough, I think it's a little bit difficult to judge, I would say. And I think right now we are at a kind of a quite difficult phase, meaning I would say consolidation and implementation of the rules. So at this very stage, I think a lot of market participants are just trying, you know, to wrap their head around, okay, taxonomy implementation, SFDR implementation, trying to find answers to some questions, which in some cases have not been answered. So I think this is overall very challenging. But I think, you know, Thierry, he highlighted some of very important, I would say, points in terms of how do we really define greenwashing? I think this is really an essential part of debate. And I think there has been, you know, to quite an extent, a lot of misunderstanding. And I think that is why now the ESA's call for evidence on greenwashing is so relevant and so important to actually that end. And what is interesting is that in the call, actually, there is already a kind of a debate and differentiation that there are different types of greenwashing, right? And well, starting by that, well, greenwashing includes sustainability-related claims that are misleading, exaggerated, outright false, or omit important information. So a little bit like what Thierry referred to, okay, are the financial market participants doing what they say they are doing, right? And in a way also looking at the fact that, yes, I mean, greenwashing can be intentional and maybe in some cases also unintentional. And I think this is a very tricky debate because indeed, due to the fact that the current sustainable finance framework we have, and in particular SFDR, is not sufficiently clear. And, you know, certain definitions are even missing, like, for instance, there is no definition of ESG characteristics, right? So I remember there have been, you know, asset managers asking now, I think for around 3 years, look, could you please provide clarity? What is exactly ESG characteristics, so we can better identify which of our products could qualify as ESG characteristics products, and then so that we can produce the related disclosures. Well, on the sustainable investments, so Article 9 products, okay, overall, at least there is a definition in Article 217, so that's already good. However, there are also still certain questions around that, and many say like, well, okay, look, both product categories are not sufficiently robust, and hence I think it was very welcome at a time when, in the renewed sustainable finance strategy of July last year, the Commission mentioned the intention to put forward actually a proposal for minimum criteria for Article 9 products. And in a way, I think many think that probably we need such criteria for Article 9 products as well. And in that actually sense, I think what is also very welcome are the recent ESMA guidance on the use of ESG and sustainability related terms in fund names, which in a way I think also try to actually close a little bit of this gap, which still remains unanswered, and to provide actually some answers and some clarity, and somehow tackle the current, difficult situation we are in, whereby maybe, well, we've been, hearing that, okay, in some cases, maybe some of the financial products that in the past were not marketed as sustainable and suddenly are being sold as products with ESG characteristics, which obviously, demonstrates, well, there is a problem. But yes, coming back, I think here to this intentionality versus unintentionality, well, on one hand side, you could also say, to what extent can you really capture intentionality in the regulation, right? Whether it would be easy enough then to tackle, I mean, how do you deal with this kind of cases? Can you, easily justify that, well, what was really your intention? But I think, kind of an answer to that is like, well, as a starting point, we need clear and robust rules. And then I think, probably part of the problems we're currently facing will go away. But look, I don't want to be overly critical, because I think, there has been so much criticism around, especially SFDR, but also the EU taxonomy. But I think sometimes it's also important we take a step back and reflect on this, and also think that actually EU has been really a leader in those rules. And that, for instance, for the countries like even now UK or US, it's just so much easier to come back with something which is, already more refined and given more thinking, because we made as Europe the first step. So I think, it's a very good starting point, but definitely we may need to consider how to complement those rules in order to actually ensure they can actually fulfill their aim to fight green and prevent greenwashing.
Thanks a lot, Alexandra. And I think a constant message, except perhaps Thierry highlighted, yes, some except definition one of greenwashing, the rules are already there, but a constant message from all the panelists, more definition, more work is required. And I think we at EIOPA, but together with the other ESAs, this is the challenge that is upon us together with our members for the next 2 years. But if I can, a concept that interests me is the concept of intentionality and unintentionality. And this is something that we've been also discussing internally at EIOPA as we work on developing a definition of greenwashing together with members. Perhaps, Patrick, of course, we said unintentional and unintentional greenwashing. We put in the call for evidence. It could be greenwashing. We haven't defined it yet. But from a supervisory perspective, do you see challenges in taking enforcement action vis-a-vis unintentional greenwashing cases, in the sense that when this is done by the insurance sector, but not with an intention of misleading clients? What is your view as a supervisor on this?
At this stage, as a French supervisor at least, but I'm ready to share my views with some my colleagues with EIOPA and my other European colleagues, but we don't think like that. We just are focused on the possibility that the consumer is not satisfied with the product that he has been sold to him because of a wrong and a misleading, probably, advertising. So we have been developing specific guidelines, for instance, for communication that include effectively ESG related arguments with the regulation as it is written as now, of course, it will evolve in the next coming months, years, it's certain, and what we could accept now could probably not be accepted maybe in 2 years or 3 years. That's the life. It's normal. The regulation is evolving because, as stated by all the participants, we are trying to learn about the what is green or not, what is the sustainable or not. It's true. So we have a regulatory framework which is new and complex. Of course, it could lead to providing information that might be sometimes not fully relevant for the consumers and the households. But on the other hand, we have seen that the fact to sell products using a green or sustainable argument is now very, very common. And we have seen that through the survey and the monitoring that we are doing on advertising materials on the French market. So promoting new product with green aspect is something which is very strong nowadays. So we need to say you can't use that kind of argument if it's not fully true. You can't say it's green if you have only something which is in your package only 5%, whatever, but something like that. So we need to have a balanced argument. It's something we are very, very focused on. So we really want to focus on the prejudice for the consumer. That is, in our view, the most important. And of course, we will learn in the next coming months and years, as I have stated previously. But clearly, we don't think now at intentional or not intentional. And as I have said previously, very shortly, the fact that the call for advice will allow all European supervisors to think together and to learn from our respective experience to try to build something what could be a clear or we hope clear and harmonized definition of greenwashing is something important to also share about the practices that we have seen on our respective market, because it's not always the same thing in all markets, and to try to work on a soft law standard, if I can say, what we call in French recommendation, but it will be guidelines in the English wording for EIOPA, is also something which is very important. And enforcement, sanction, or things like that, it's the last stage when we have failed to convince the market to have the good behavior.
Yeah. Thanks a lot, Patrick. And I hear Alexandra referring to ESMA's guidelines, SCPR working on guidelines on ensuring that the usage of green names, green labels, there are some minimum requirements. But perhaps Thierry, Patrick commented on the fact that it doesn't matter if it's intentional or unintentional for there to be greenwashing, but there needs to be customer dissatisfaction, there needs to be detriment. And this is something that we as in our call for evidence, we're also consulting on. In your view, as a consumer representative, do you think that there can be greenwashing even though there is no direct consumer detriment? Or if there needs to be consumer detriment, how do you think that it can be quantified? Perhaps in 2-3 minutes, that would be very helpful. Thanks, Thierry.
I will try. I think that when it comes to greenwashing, the idea is less to think detriment, because detriment is really detriment to the planet. So if you take it back to one particular consumer, it's difficult. Well, yes, that person is impacted, but it's it's really another story. I think the question is the traditional, and in a way, that's what I said earlier, the traditional question in financial markets, which is to know whether the information given is clear, whether it's accurate, and whether it's not misleading. And if the information is clear, accurate, and not misleading, then we have a customer that does not have the impression of being given a false promise. And this is really what we're talking about. So it's not detriment as in on financial product, basically the person is losing money. It's another dimension, because it's a non-financial dimension by definition, as we're talking sustainability. So really, the objective here is to make sure that that person doesn't feel that he or she has been cheated, to use a very common expression. And then there is another dimension which is very important, because when you think about it, sustainable finance can mean one of two things, or perhaps the two, but certainly, two possible ways of conceiving sustainable finance and therefore greenwashing. First conception is the person investing gaining exposure to the variation of the prices of the assets that the financial product exposes that person to? That's one thing, exposure to the variation of prices. Or is the financial product bringing capital to a company, to a corporate, to an enterprise that will use it either to operate as a sustainable activity or a sustainable entity, or to build a sustainable future, to be on a transition pathway? So what I'm saying here is, is it exposure to price variation, or is it bringing capital to productive use and sustainable productive use? And that is a very important distinction. And that's something we have to bear in mind, because I would be ready to bet that the vast majority of savers expect their money to go to finance either a sustainable economy or the transition to a sustainable economy. So we need to think very hard about this. Otherwise, here again, we will go into disappointment of savers and investors, which will have very negative consequences.
Thanks, Iri. And maybe just to go back to your point that in order, therefore, not to be detriment, the information is to be clear, fair, and not misleading. I mean, these have concepts that have been in the regulatory framework, at least since 2018 with the introduction of the IDD, but even before. And maybe onto you, Alexandra, the call for advice on greenwashing asks us to look at whether the regulatory framework is fit for purpose. And what we hear is, we hear from Thierry, these three requirements, but what we also hear from the market is that there is too much complexity. So should we go back to the principles that Thierry highlighted? But we also hear from this panel as well, there needs to be clarity, and you highlighted earlier in your intervention what can be sustainable, what is not sustainable, what contributes to transition or not. So there is this dichotomy, these different views. If you were to advise us and tell us, okay, this is what needs to be changed in the regulatory framework, what are your views?
Thank you for this question. Well, I think we are not really all so far apart, I think, from what we are trying to say on this panel. And well, please feel free to correct me if I'm wrong. But I think talking about, for instance, certain, I don't know, when we talk about regularity, ambiguity, or complexity, I don't think we are necessarily right now calling for, I don't know, stripping down rules or, removing them. I think it's more about trying to reflect on how and whether all the pieces of the sustainable finance puzzle fit together and see where we need to calibrate them. So, for instance, we definitely need to calibrate a little bit SFDR regulation, okay? And I think, to ensure that, yes, there is clarity on what constitutes products with ESG characteristics, maybe even, reflect a little bit further, like, look, it's been intended as a disclosures regulation. However, it went kind of, one step forward towards really creating an ESG standard. And we've seen products being marketed as Article 8 or Article 9 products. So then, it requires a little bit of reflection whether we need to actually, go, well, if you say A, maybe then you need to see also B and, kind of complete this process, set the minimum criteria for Article 8 and 9 products, ensure it's all clear in terms of, what the regulation says, so that the financial market participants know how to implement that, right? And okay, then whether it could be turned into kind of a proper, fully fledged ESG standard, or whether you just want to create some labels on top of that. Okay, that's I would say another question, and I think there can be pros and cons of kind of both approaches, and we can debate it further. Maybe one thing that is definitely also, I think, missing is yes, a kind of a more impact/transitional category, right? Which, for instance, has been reflected in UK SDR rules that have been, proposed and now put forward up for a consultation. And I think there are reasons for why it's not there in our framework, because at a time when SFDR was conceived, I think the debate was focused more on how to mobilize finance for investments which are already green, right, are already sustainable. Over time, I think the debate has shifted into how to mobilize finance for the transition and kind of helping those companies that are not green to kind of, transition towards green. And of course, we could now probably spend, at least 1 hour debating to what extent the existing Sustainable Investments Article 9 versus Article 8, the ESG characteristic categories, could somehow, host somehow the transition impact funds. But yeah, probably, there is more reflection on that needed altogether. I just wanted to make one more point, which I think is very important. So this ESMA consultation on the draft guidance on the use of ESG and sustainability related terms in fund names. Again, very important. And I think this is, here an attempt to address this issue to some extent, especially for Article 8 products. Now, what concerns me is that for now, I understand it focuses only on investment funds, and that it does not actually, it is not intended to apply to insurance and pensions products, which I would think is actually a pity, because I think anyway, SFDR applies to all financial products, including actually insurance and pensions, right? Products. And I think, some of the challenges and ambiguities that currently exist are also, I would say, applying to these products. And hence, I think, more clarity and ensuring that indeed there are some, I would say, rules or, well, guidelines in this case, right? In terms of like, well, if you use a term ESG in your fund name or sustainable in your fund name, then, okay, what are the minimum criteria that such funds need to meet? I think that should definitely equally apply to insurance and pensions products, which in some countries in particular are being sold much more often to retail investors.
Thanks for Alessandra. Just a quick comment on that. I think we very welcome ESMA's consultation, and we as EIOPA were closely discussing with ESMA and seeing how the consultation evolves. Indeed, we see also additional issues in the insurance world in relation to MOPs. To what extent can a wrapper be an Article 8? And then there might be a few underlying options that are Article 8, but perhaps a theme that was also mentioned by Thierry and earlier by Katarina. And Katarina, maybe back to you. If you were to advise to us as an industry, as the insurance, as the one who needs to develop this product, what is the missing linkage in the regulatory framework? What, in your view, needs to be done further? Would you agree with Alexandra that this transitioning part, these products that finance the transition, are the missing angle? And maybe in 3 minutes, so we have 10 minutes for Q&A from the audience. Thanks a lot.
Yeah, thank you, Marco. I agree a lot with what has been said so far. However, let me start really first to express my fullest respect to the massive conceptual work that has been done by the Commission to set up this framework we are currently working on. It's really, they started from scratch on a white piece of paper, and as has been mentioned, it's always easy to criticize, but to draft something that is so massive, it's not only SFDR, we have the IDD, we have Solvency II amendments, we have CSRD in the making, and it has a lot already of design in it. We have CSDDD coming, so it's really conceptually thought through so fundamentally, and I would say it is enormous and it's enormously good. Yeah, and I would really make this a very bold statement. We, of course, also all know that this needs to be further developed and specified and worked on. And there are many areas that deserve clarification and further development in detail. This is also clear, but we really want to support that the Commission continues on this path and really further details and also finalizes the work that has been started also on CSRD and CSDDD, so that we have this kind of very complex and complementary picture of the various pieces of regulation, ideally to fit nicely together. Until this is all there, there will be, of course, areas that are not only now vague and weak, but this may really take quite a while. And what I believe is, it sounds so easy to cry for strict rules. I would rather say, or we would rather say, let's create a constructive atmosphere where improvements can be discussed and where best practice can be shared, so that we really collectively learn, and collectively also needs not only and us here from the financial industry, we need to have scientists, we need to have the other industries, we really need to embed this collective learning on climate change, mitigation, adaptation, now the discussion around biodiversity, so many dimensions up to human rights. So sustainability is a very, very broad term, and we really need to work on that and create an atmosphere of mutual and collective learning. And that is, I think, then a basis where also, let's say, the further development should be established on. So with that, I also think that this is not only about exchange at expert level. There is also a need that training and education is provided to the wider public, and that this really becomes a common knowledge of the consumer side, that everybody can understand that there are so many steps to go. Everybody needs to do his own steps or her own steps, and that is the atmosphere we need to create. Because with that, so if we undermine this trust that we all need and the confidence that everybody can contribute, we really might really risk that we undermine the efforts that are there. So rather the opposite, I hope that we can keep up the high motivation that is needed to fight the climate change risk and to cater for climate change adaptation, including, and we didn't mention this a lot here, but also including a just transition, because we really certainly we do not want to leave anybody behind. And also with that, it's important that we put a lot of thinking in the overall framework that we create. So thank you for that, Marco.
Katerina, and I would like to reiterate the positive message. I think, some divergences of view from the panelists, but overall the message is it's a difficult path ahead, but we're all in this together. We all need to ensure that the sector contributes to the transition. And of course, Alexander mentioned it earlier, the EU was self-starter, so it might get a bit more bumping, and we might look at other jurisdictions and look, oh, maybe they're doing it better. But I guess they have the competitive advantage of looking at what we did in the EU and see what worked, what didn't work. But maybe we have 7 minutes left for the panel. Pamela, a couple of Q&As from the audience. The hashtag is EIOPA, and there was also the QR code projected earlier. Thanks, Pamela.
Yes, thank you very much, Marco. Thank you very much to the panelists. And Marco, you heard for this morning, difference in opinion is valued in the discussions. That the cognitive diversity is actually the diversity we're aiming for. But what I see from the discussion and what I hear also from the questions that are being raised, maybe again a cheeky question, and maybe more to the industry, Katerina, and apologies in advance, but imagine you would have the perfect information on your investee. Would you be able to make a sustainable investment, or what would it take to make a proper financial instrument that really is not making wrong assumptions and is not actually deceiving the consumer, but maybe even addressing collective detriment? Thank you.
So now, thank you for this question. We are talking about the ideal world, right? Where we know everything and where we have the instruments. I think that, of course, then, once we are there, it should not be so difficult, because then we would have clear understanding on methodologies that we apply, on metrics that we apply, how to evaluate data and information that we get. I really think that once we have the information also that CSRD is now trying to collect and to present, this will make the lives of those who have to take investment decisions much easier. It will also make it much easier to have informed discussion with investee companies or with industry who is seeking insurance coverage, where they stand in their own transformation of their economic activities. And on such basis, one could evaluate whether a financing of this or that project or this or that company or insuring this or that company would have an integral part that either is already in line with the EU taxonomy and therefore can be considered sustainable, or whether this corporate has a business plan in line with the net zero ambition under the Paris Agreement, and where then the investor or the insurance company can say, okay, to this and that degree, they are well on track. And that also then can be integrated in the product transparency itself. So towards the customer, we could make this transparency within the diversity of target investments we have done, or within the diversity of insured customer, the range of business activities that are deemed already being compliant with these thresholds, and those that are not yet but underway, but in line with, let's say, science pathways, that we would be able to much better explain than we can do this at this point in time. So I think, yes, it's feasible, but there is a lot of work ahead for all participants in the market, including the real economy.
And it's good that you mentioned the real economy in the end, because I'm not sure whether we will ever get to a perfect state of the stricter rules, the perfect regulation by which you can avoid all misunderstandings. But that, I think, you've already shown. Another question coming up, because we're talking a lot of SFDR, about disclosure, regulation, but what about the normative requirements? I mean, what are the due diligence requirements that you expect today insurance companies should have actually on their products? And we're talking here of the current discussions also under the CSDDD, where I think some tribulations have happened. So maybe Thierry, would you care to comment maybe from a French perspective or from a global perspective? Thank you.
With pleasure. Fact is, I am French. I have French passport, but my job is not to speak from a French perspective, if I may. I don't represent anybody official in France, and certainly not the French government. So I will just use my Finance Watch hat to comment on the recent CSDDD exemption of financial companies from the due diligence. The very, very polite way of saying it, it's a huge lost opportunity. It is extremely unfortunate. And at the end of the day, it creates, not only it creates a loophole, because that means that especially, and perhaps Patrick will be happy to comment on this, on the banking side, it means that banks will be able to extend loans to companies without checking the number of very fundamental things, whether on the environmental or the human rights dimension in their value chain, which is a big problem. But also it is at the disadvantage of the many financial institutions throughout Europe. And we've seen quite a lot of them saying, we need it, it needs to be done, and we're already doing it. And now we're saying the regulation is saying, oh, by the way, you don't have to do it. If it's adopted by the parliament, we're not there yet. We still have several months because, as we know, we have co-legislators. So this is extremely unfortunate, to put it politely. And yes, you obviously referred, to the fact that, given the fact that I'm French, that the French government played a role in this one. And I do regret that the government, my home country, took that position, I have to say, officially.
No, and I didn't want to put you in a corner.
No,
we're all European on this panel.
It's my job to say what I think, and I have no problem people saying I don't agree with you.
Of course. Thank you very much. But indeed, there is a bit of vicious circle between the normative requirements and the disclosure requirements. I mean, how will you square this circle? But then again, coming back, Patrick, on the ESG labels, I mean, where is this heading, do you think? I mean, ESG labels are popping up and all the claims are being made, but still, these ESG labels are neither SFDR compliant nor taxonomy compliant. So eventually, indeed, what can a supervisor then do, or how do you assess the risks that these ESG labels are causing in the market?
Oh, label. It's not very specific to the financial industry. In fact, we have the same matter for the food, for instance, for pharmaceutical or cosmetics and things like that. So each time you have a label, you have something which has been checked and verified by the label. But of course, for the consumer, it's not very transparent. He doesn't know that there is a difference between label A and label B. So at least we think that it could be, it's another layer of information that could be given to the consumer, to the policyholder for insurance, to understand what the label has done exactly when he has given its label to a financial product. Because if you don't know how it works, you can say, oh, that's fine, I have a label, but it's not very informative as such. So I'm a little bit embarrassed with that question of label. We think that it could be very useful, but at least that we need to have a common minimum setup of things to check by every label. After that, they can have something else more, but not less.
Yes, and why not use Article 8 and 9 as a label? That's my question.
Absolutely.
But there's a lot of creativity in the market, and not just for the right reasons. And a final question which I have received is indeed, Alexandra, I mean, indeed, the Commission has reiterated its view that the financial market should participate in financing the green transition. But of course, what we see is more a focus of the industry on financing green and maybe less on financing transition, or trying to actually leverage on the investees' activities and try to actually promote sustainable characteristics, even where the activity may not be the greenest from the outset. So what is your view on how the financial industry could also focus more on financing the transition, the transitional activity? I think we have a bit of a bandwidth problem, Alexandra.
Sorry, just to clarify, it was intended for me, Pamela.
Yes, Alexandra, yes, indeed.
Yep. Yeah, can you hear me?
Perfect.
Yeah, indeed. I'm afraid there are some, I think, issues. Yes, speaking in terms of the transition, like, look, obviously, I think there are already in existence on the market impact and transition-oriented funds, right? So, of course, I would say even right now, I mean, financial market participants, of course, they can, well, produce, basically, manufacture such funds if they wish so. But indeed, you know, if we want to talk about somehow incentivizing it by, or enabling by certain rules, or at least, you know, I think, yes, there is a need to somehow, I think, calibrate the existing EU regulatory framework to kind of also clarify, yes, I mean, in terms of the different existing disclosures, categories, criteria, in a way, yes, which of the even SFDR categories would be better suited for it, or maybe, as I mentioned, maybe indeed we need to actually create a new category that would be more focused on the transition impact. Because, yeah, we could discuss, look, like, to some extent, if you look at the definition of Article 217 of SFDR, yes, it can actually be to some extent be suitable for an impact fund in a sense that the investments must pursue an environmental or social objective, and then there are some interesting, some examples of, what measures could be considered for the purpose. So that could work for instance, an impact fund. However, if we speak specifically about transition kind of oriented funds, it might happen that some of them, for instance, indeed invest in companies which are still reliant on fossil fuel exposures, for instance, right? So they are not carbon neutral or green yet. However, they have a robust, plan to get there. So hopefully there will be carbon neutral in the future, which in general would seem to fit, I would say, the ideology of impact or transition here related investments. But then you could argue that the Article 217 of SFDR, which provides a definition for the so-called Article 9 products, right? So sustainable investments would not definitely, it's not perfectly suited in a sense. You do no significant harm criteria, and there is also a consideration of the carbon footprint. So in that case, you might still say, okay, it could better qualify for Article 8, but then, we know that Article 8 is very, very vague. So yes, we may need, similarly to what actually has been put forward and proposed in UK with SDR, we may need to consider, a category of improvers, right? Or transition, whatever else. But again, in terms of, I would say, the market, there is of course nothing that prevents the industry to do that. But I think what is very crucial for that is to consider stewardship and engagement and its great potential to actually, as a tool for investors to, help in a way push companies in the direction of becoming more environmentally or socially sustainable, right? So I would just leave it at that.
Thank you, Alexandra. Marco, I'm done.
No,
These are the questions.
I just want to thank all the panelists for the useful discussion, and of course we will be working on our call for advice to the Commission up until May 2024, and together with all the stakeholders represented in this panel, but also a broader set of stakeholders. Thanks a lot for joining us today and for the useful discussion. And Pamela, the floor back to you.
Thank you very much also from my side. And then my final thanks to the audience and a few concluding remarks. So here we are at the end of our conference, our 6th event on sustainable finance. And as I mentioned in the morning, we would like to tilt the discussion. Now, did we tilt it? Did we bring ourselves and did we bring some key opinion leaders further down the path to adapt? Because as we said, without adaptation and change of mind, there's only so much we can do to address sustainability risks. So on the program, we discussed how improved risk assessment, awareness and prevention measures are key to rein in climate losses. And that is a very important point, prevention. And also how innovation, not only innovation, technological innovation, but also innovation in the thinking in corporate boards, in public-private cooperation is key to adaptation. So I hope we've already shown that prevention and innovation go hand in hand, and that's the way to adaptation. But we've also seen that to think of climate change risks from a financial stability perspective does give a bigger picture and shows how climate change is affecting fiscal powers, is affecting financial resilience of countries and regions as a whole. And that gives, I think, a clearer perspective of how we should adapt to climate change in cooperation also with emerging countries and with vulnerable communities. But we've also seen that in addressing protection gaps, which are arising not only in climate risks, but also in cyber, in pandemic, in business interruption risks, we see that the drivers are not just the offer of products, there is also the demand for products and, as mentioned, the insight into the macro socio-economic effects of these protection gaps. And in order to address protection gaps, we have to understand these three key drivers. And if we pair that with incentives that are tilted towards prevention measures, to reducing the losses, we can make a very strong impetus for addressing these protection gaps. There is not one single road, not one single regulatory measure, but a variety of measures we can take, and there is a way forward. And as always, in a supervisory regulatory conference, we have discussed regulatory challenges and opportunities for bringing pension funds and insurance companies closer to fulfilling their stewardship roles for long-term sustainable investments. But we also need to understand that regulation can only do that much, and especially in addressing the risk of greenwashing, which is a risk that we are addressing because unclear or complex products for consumers create actually a risk for companies. But there is more to that. There's more than the consumer detriment of being deceived. There is a clear need for honest products that actually will benefit society more broadly. And that is also the duty of insurers and pension funds. So if we want the financial sector to adapt to sustainability risks, that was my first question at the start of the day. We don't need hope to take action. But we need, and we do not need success to persevere. But we need to adapt to be successful. And that is a bit freely interpreted what Willem van Oranje said a few hundred years ago. And I hope this gives you enough impulse and enough support to continue the way towards adapting our society and adapting our behavior and our minds to actually fight climate change and sustainability risks. Thank you very much for having attended this conference, and I hope to see you soon at one of our other events, and I hope to read all your comments on our publications, and feel free to reach out to us on any suggestions you may have to improve. Thank you very much, and enjoy the rest of the afternoon.